A stake. But Anna, we're nearly at the open.
Okay, yes, absolutely. So we'll watch that developing story around EssilorLuxottica and Meta's intentions. We have those stocks to watch then, very much in focus as we get to the start of European trade for this Friday morning. Kriti was taking us through the futures. She's right, it was very marginal really, wasn't it, which side we were going to head on these markets. But what we've got so far looks pretty mixed. The IBEX is down by 0.4%, a little more volatile, a little more responsive perhaps to news flow than some of the other markets. The FTSE is pretty flat this morning. It's interesting to think about the recent drivers of activity, the slowdown in China, what that's been doing to basic resources, the slowdown in China and what that's been doing to the luxury sector, all of that weighing. And there is a China theme running through the auto sector as well. So it does feel as if perhaps that China link and the pull of the Chinese economy into Europe, that is having an increasing impact this quarter round when it comes to the earnings stories, and we're sort of paying the price for some of that. For the moment then, we see a bit of outperformance on the London market. We are not open yet on the DAX or on the CAC, but we do have a little bit of upside in London. Elsewhere, some downdraft, and so we're pretty flat overall then, Kriti. Let's take a bit of a deeper dive into what's on the move so far.
Yeah, it looks like the winners of yesterday are today's losers and vice versa. The idea here seeing that Unilever, for example, outperformed the market yesterday. Today, it is not only one of your kind of drops, but it also is your biggest weight on the FTSE 100. But to the upside, you are seeing a lot of the energy names, your Shells, BPs, Rio even getting in on the trade, Glencore, we even have Anglo American. I'll throw Total in there as well because it is pushing the upside on the stock 600, although it's kind of flirting with that line of what's actually moving. So it feels like energy really in focus this morning, Lizzie.
Yeah, really, it's a mixed picture in the stock 600. If you break the sectoral basket down, roughly half in positive territory. Energy, as you say, leading the gains, higher more than 1% this morning. But bottom of the basket, you have food, beverages and tobacco, telecoms, tech. Just looking at some of those individual movers that we were talking about earlier, and we spoke to Man Group, of course. Those shares higher 2.7% off the back of their earnings. Rightmove higher 2.3%. Hermes, we've been expecting an outperformance, 1.6% higher this morning. We await Mercedes, we await NatWest, but Holcim, we spoke to them as well, lower 2.4% at the open. We still await Vontobel, despite our conversation.
So some of those stocks not open yet. We do have an opening trade, though, on Eni, the Italian energy business, and they've raised their full-year guidance, profit beating estimates. So even though we don't have much of a move in the oil price, that is enough to lift that whole sector, it would seem. And we are seeing strength there. Second quarter earnings beating, strong upstream performance seems to be the story. Higher crude prices offset weakness in the gas and refining margins. So it's an interesting one because we're going to move into next week with some more news coming through from that sector. So we'll keep an eye on that. But Eni to the upside this morning, up by around 3%.
I'm just zeroing in on those negative movers there. Your Nestle and Unilever are your worst performers. That's a really interesting trade. Lizzie, you were doing that interview with Unilever yesterday. So to see a complete turnaround in the markets. I also mentioned, speaking of turnarounds, when you look at the stock 600, and I'm going to talk about the kind of underperformance in the IBEX as well, because that's where you're seeing a lot of the pain this morning as we await the opening trades on the DAX and the CAC Iran as well. Banks seem to be the weight across the board. And this is a really interesting dynamic, given you're seeing that show up in the FTSE 100 as well, where you see the likes of Standard Chartered, for example, SocGen as well, and even Lloyd's, all lower this morning, Anna.
Yeah, absolutely. So a real focus on the banking sector. We had Lloyd's numbers yesterday, NatWest numbers out this morning. Let's pivot to the autos because, again, we've had plenty of earnings stories to digest. Yesterday with the likes of Renault and Stellantis, both really weighing on European markets. Today we got Mercedes-Benz out with their numbers, cutting their margin outlook after EV and China sales dropped. Let's get the latest details from Bloomberg's Oliver Crook, who has been following the auto space, of course, from Germany. Ollie, good morning. Mercedes earnings. Take us through some of the detail here. Again, it's another story of China weakness.
Yeah, that's right, Anna. And listen, we had their volume figures out aloud. They pre-released those down about 6%. The real question with Mercedes, because they don't really do the volume play, they're trying to play on margins. They're willing to sacrifice a bit of volume in the sort of for margin. Those margins came in at 10.2%. That was more or less in line. But when you look at their revenue figures, EBIT, net profit, they were all down and down hard. Revenue was down 4%, EBIT down 19%, net profit down 16%. But we should say, Anna, that was from fairly reduced expectations. Those were actually beats compared to what the market had been anticipating. So we were sort of looking at going into the market open. We also got their outlook. They confirmed their guidance. They adjusted their return on sales, their margin, so they lowered that just a little bit. It was supposed to be between 10 and 12%. They adjusted that down to 10 and 11%. They still see weakness in China. They still see caution in China. They still have a lot of caution around the question of global trade. But, Anna, in the scheme of sort of earnings we got out of the auto sector this week on really bad numbers and really bad market reactions, not such a bad reaction in the market here so far, down 1.75% in the early trade here for Mercedes.
Okay, crucial context there, Ollie. Just talk to us about the EV transition as well and how that impacts Mercedes.
Yeah, well, I mean, it will impact everybody a lot in sort of going forward for these sort of months and years to come. But really, the focus has been moving for these auto sectors really across the board in terms of kind of their sales right now, right? Let's take a look at some of the movers across the auto sector that we had yesterday, where we had Stellantis down about 9%. They had their worst day since 2021. Renault closed down 7%, was down as much as 14%. And Ford, guys, Ford overnight down 18%. We're talking about the Ford Motor Company losing almost a fifth of its value just on the earnings out yesterday. That is the biggest move that we saw on Ford since the financial crisis. And to kind of put it into context for all of us, we also spoke to the Stellantis CEO yesterday. Have a listen to what he had to say.
The automakers are under pressure. The auto industry is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil.
So listen, we're talking about years to come here from Carlos Tavares. What I think is interesting is that actually nothing has changed on the broad story for the auto sector, but this is really feeling like the quarter where the rubber is hitting the road. The delay in EV sales, the competition from China, the weak market within China, and you're really seeing that illustrated. And the bottom line is, guys, it is a crowded space, a crowded market where the demand is just not there.
Bloomberg's Oliver Crook, we thank you so much for walking us through that Mercedes story. Of course, he has been monitoring the auto space quite significantly as it weighs broadly on the DAX as well. I should just mention we are getting the opening prices out of NatWest. Those shares higher by 7%. We're going to dive in those market dynamics shortly. But another one of the outperformers in this session is Hermes, which is interesting, kind of fighting the grain. Again, we're going against the grain, I should say, when it comes to the luxury space. I want to dive more into the story. Andrea Felstead from Bloomberg Opinion joins us right here around set. Andrea, how are they weathering this storm in a sector that no one has really seemed to manage well, except for the maker of the Birkins?
Well, there's two things going on. They have the Birkin bag, the Kelly bags, which everybody wants, and which, there are long waiting lists for. Because they're so high priced, they sell to, the very affluent. So they've got those two things going on. When demand goes down, because they have those long waiting lists, they can simply work through those lists of customers that want them. So it makes them very resilient. But they haven't been immune from the pressures. The silk, the ties and silk scarves, which are typically a way for less affluent middle-class customers to buy into the brand, they're down, as are watches. So yes, they have outperformed, but not immune from the industry pressures.
I know Tom Mackenzie's a fan of an Hermes tie, but let me ask you about the China picture. Is it as bad for Hermes as it has been for the other luxury names reporting this week?
They do say that the sector that includes China is not as strong as the others. Again, it will be, hot brands, more affluent customers. It will be more insulated. but I don't think it will escape the pressure on China.
So that's the earnings stories that we've been dealing with this week. There's other news, Andrea, in the luxury space, and that is around the Olympics, because LVMH, and I know you've been writing about this, the LVMH as creative partner to the Olympics, unprecedented, you say, intermingling of sport and luxury. Are we set to see, yes, a lot of sport over the next 2 weeks, but also a lot of LVMH?
We will see a lot of LVMH, definitely. I mean, they're going to be everywhere. You know, they're making the medals, the outfits for the French team. You know, one of the most interesting things, when the medals are presented at all of the medal ceremonies, they'll be on an LVMH tray. They'll be on a Louis Vuitton tray. In the check, the damier check, which is one of the most, you know, iconic patterns. And the idea is everyone's watching the Olympics, one of the few events that lots of people watch together. You know, whatever your background, you may be watching the Olympics. And, you know, you might not be in the market for a bag or a wallet today, but then when you are, you think, oh, I want a bag, I want a card holder. Oh, yeah, I remember seeing that check at the Olympics. And you go and buy it.
I can't say I've ever paid any attention to the thing that the medals are presented on, but now I will, thanks to Andrea. Thank you.
The platforms, you know, if I like enough, I might even just get one built just for the set, just so we have one to stand on as well.
To award our medals.
Yes, just to get through a show, we get it. Andrea Felstead from Bloomberg Opinion, we thank you so much for walking us through that. Let's get a quick check on the sensational six as well, because if it is a question of the heavyweights, remember, this is where you've seen a lot of the movement as well. Novo Nordisk, for example, I'm just going to go left to right here, is actually in the green. Remember, it was one of your underperformers in yesterday's session, as was ASML. LVMH, really flat. I'm not going to say that's going to call that outperformance here. Nestle is what's catching my eye, though, down 1.8%. Remember, in yesterday's session, you did see Nestle take a beating. It looks like that beating continues this morning. It's a little bit of a mixed picture when we talk about the sensational six. Let's get a quick check on some of the other stocks on the move. Lizzie Burden, over to you.
Well, let's get back to NatWest, Critty, because those shares are up 8.4% this morning off the back of their earnings. They dropped about 7 a.m., boosting its forecast for the full year revenue after that net interest income dropped less than analysts had expected in the second quarter. We also had that scoop from our colleague Ellen Milligan about the preference by the UK Chancellor Rachel Reeves to lean towards offloading towards institutional investors these shares post-financial crisis, of course, rather than the retail market. And it seems that investors are liking the whole package this morning. But let's take a look as well at Eni. Those shares up more than 3% this morning. Still, and it's because it increased its full year profit guidance earlier. You've had, of course, European energy companies contending with competing winds. You've had, on the one hand, the weak fuel demand, so falling refining margins. You've also had lower natural gas prices. But then, on the other hand, of course, you've had this positive effect of higher crude prices because of these OPEC plus supply cuts. So, Eni there, higher 3.3%. But let's just take a look at the Ray-Ban maker, finally. Essilor-Luxottica, higher, more than 6% earlier, but paring a bit of those gains now to 5.4%. It is off the back of the confirmation last night that Meta is potentially interested in taking a stake. Of course, they've had this years-long partnership over their smart glasses, and it looks like that's going to be strengthened even more. Investors liking that this morning. Anna.
Lizzie, thanks for that. So Lizzie Burden with an update, of course, on the stocks on the move this morning. Coming up, we take a look at the latest moves in currency markets. Jane Foley joins us. We've seen a lot of activity around the yen of late. Also, the yuan, very topical this week, given what's happening in the US election and what pressure that might put on Chinese policymakers. A lot to discuss then with Head of FX Strategy at Rabobank, Jane Foley. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the opening trade. We're about 15 minutes into the session. We are seeing a little bit of a mixed story in equities, but I want to take a moment and talk about what's going on in this FX market, because you are seeing, I'm going to call it a very technical term, some wonky moves in this market, especially when you look at dollar yen here. 153 handles where we're at, just shy of 154. The strength in the yen has been pretty substantial. When you look at some of the other European currencies as well, you are seeing strength. 128.60 on cable, 108 handle still on euro dollar, and even dollar yuan is getting very interesting, because some would say there is a little bit of a Trump trade situation, a little bit of some unexpected rate cuts over in China. Luckily for us, we've got someone to cover it all. Jane Foley joins us this morning, head of FX strategy at Rabobank. Jane, no pressure. We'll just talk about the entire world with you in a couple of minutes. Let's start with the yen, though, because I'm confused at the move that we're seeing. I want to say just 30 days ago, we were talking about 162, 163 on dollar yen. I'm looking at a 153 handle right now, and a move that's really kind of accelerated in really just the last couple of sessions. What are we attributing that to? Is that hedging, positioning? Is it as simple as anticipation of a hike next week? How would you view that?
You know, I honestly think, given the immense, huge move that we've seen in the last few days, that this is really a lot of speculators all rushing for the doors all at the same time. Because if you look at some of the themes for this year, for the G10 FX market, a lot of it was, oh, you know, the yen is going to be that funding currency. It almost doesn't matter, even if the Bank of Japan were to hike interest rates, the moves are going to be so small that it's still going to be you know, there's still going to be carry trades and the yen's going to be the funding currency. There was such a huge weight of the consensus in that trade that I think when it started to turn on the back of the intervention, on the back of the dollar weakening in July, as the Fed September interest rate hike became more likely, then the market just started to run for the exits all at the same time. But now that we've had that big initial clearing out of positions, the market is going to start to look back to those fundamentals. And yes, we do have on July the 31st that Bank of Japan meeting, but actually the majority of sort of seasoned economists are not expecting a hike. And so that might mean that we get a little bit, perhaps a little bit of an upside in dollar yen, a little bit of you know, that rush to the exits sort of ending for a little while at least now.
You talked about the carry trade as well, the yen being kind of that funding currency. We've seen that carry trade kind of, I don't want to say come in and out, but just fade just a little bit after some of the elections that we saw in Mexico, arguably the Brazilian real as well. the Trump trade is some kind of thrown in there a little bit. We'll put that to the side for a second. But if we're talking about cuts from the Fed, we talk about positioning for the dollar and then a hike from the yen. Walk us through the carry trade du jour of the next 6 months.
Well, I think the carry trade will still be there. I think perhaps it's not so quite straightforward as you've been pointing out over the next few months, but it has been the big theme of this year for foreign exchange. Interest rate differentials, they have been the big theme. Even if we look at July, for instance, we had, the Trump trade. A lot of people, thinking at that point, before Biden stepped aside, that Trump was going to win that election. The Trump trade was on. We were thinking, well, that's going to be inflationary. That means that the Fed isn't going to cut interest rates so much. And yet the dollar was weakening because it was focused really on September and the chances of an interest rate hike. So it's the interest rate differentials really have dominated. Now, I don't think that theme can be swept aside quickly, even though the politics are seeping through.
Isn't that a positioning story, though? Isn't that just an unwind of dollar longs?
Well, that's all part of it too. So, but certainly, I don't think it's totally over. But I think it has changed, and I think people might be willing to go into those trades and be a little bit more cautious, be perhaps a bit more nimble, willing to get out. But I think politics, clearly, as we go into November, is going to become the overriding theme.
You bait me with the Trump trade, Jane, but I want to turn to the UK politics and the strength that we've been seeing in the pound, this world-beating run of gains, and you've been a cheerleader for the pound for some time. I wonder if it is because we've got this newfound experience of political stability, or whether actually it's starting to reflect actual strength.
Well, one thing that I would say about the pound is that, yes, it is now the best performing G10 currency in the year to date. Yes, it was the second best performing G10 currency last year too, but it's not a strong currency. So if you look at it in terms of just, what the models are saying, or if you just look in terms of long-term averages against the euro and the dollar, it's still not a strong currency. And one way that I like to look at sterling is that, in September 2022, which was, of course, the Liz Truss time, cable hit an all-time low, an all-time low ever. So what I like to think about sterling, it's a currency that's picking itself up onto its feet, based and really prompted really by a much more political, stable outlook last year, as well as this year, compared with what was before. And I think if we do get good news in terms of investment flows, investor confidence, perhaps first of all, and perhaps a better news in terms of the consumer at some point, then I think sterling can build upon those gains. But one thing that worries me right now is that positioning data is beginning to show that the market is long of sterling. So it's a little bit more complicated to be or to call for those gains when everybody is sort of already on that trade.
Well, yeah, because I do wonder whether it's going to lose steam in the second half when we haven't talked about the Bank of England. Yesterday we saw, the bets piling into the BOE starting to cut soon, possibly next week. Where does that leave you on the pound?
Well, again, I think it's very complicated against the US dollar, partly because of what you've just been saying and partly because of the US political uncertainty too. I think that perhaps we can look for a little bit more clarity against the euro. But you know what? The euro is the third best performing G10 currency this year. The story of euro resilience, I think, this year has been really quite remarkable when you think about the weakness of the German economy and when you think about what's going on in French politics. I don't think we've heard the end of those stories yet. I think the euro could still come towards, a few bumps in the road. But I do think that if we maintain this view that investment growth may outperform in the UK, because it's been really, investment growth has been quite static for quite a long time in the UK, then sterling could have an edge. And again, partly because historically, sterling is still fairly soft against the euro.
Yeah, the euro strength, despite the fact we saw that ECB cut before the Fed. I mean, maybe people not thinking they diverged too much. Let me take us back to the dollar conversation, because you were saying that the Trump trade had been applied because of the polling, and that led people to conclude that would be inflationary, that there would be tariffs would mean more inflation and the Fed doesn't cut rates so much. But then how do you balance that against the rhetoric from President Trump, from his vice president nominee? How do you balance the rhetoric? Does the rhetoric matter? Because they talk about wanting a weaker dollar. Is that of no importance?
It is obviously important. But I think we've got to look at the US economy as being such a credible economy. The central bank, the Federal Reserve, has been a credible central bank. Because if we don't, we're looking at a situation like Erdogan in Turkey, when Erdogan, put his own people into the central bank lost its independence, and interest rates were cut, inflation was huge. We've got to assume that that cannot happen in the US.
Yeah.
And if we assume that that cannot happen in the US, and that political interference is going to be very limited in terms of what the Federal Reserve can do, then we've got to assume that it's going to be fundamentals that are going to drive the dollar. And if we're talking about a more protectionist US economy, if we're talking about the possibility of Trump tax cuts, then we've got to consider that inflation in the US is going to be a little bit more worrisome than it would be otherwise, and that the Federal Reserve won't be able to cut interest rates that much.
And if you're thinking about the other side of a dollar trade, I mean, many options are available, but the mind goes to China and the world's second largest economy. If Trump did want a weaker dollar, that might mean we'd have to see a stronger yuan, and the Chinese are not going to be minded to create that environment right now, given all the headwinds that face the Chinese economy.
Well, that's right, but in a way, clearly the situation is extremely complex, and anything to do with trade and investment flows is very complex. But in some respects, it boils down, to a very simple outlook, which is the market right now is not confident about investing in China. The market is not confident about Chinese growth, given the rhetoric between the US and China. And I would stress, this isn't all about Trump. We've seen in the Biden administration no real moves to move back to, the freer trade environment that we had. We've seen Janet Yellen basically explain to us that this isn't about just free trade. It's about free trade when we have one partner cheating and therefore sort of ruining the environment for everybody. So if the US remain, irrespective of the president, wary about that relationship with China, investors are going to be wary about investment in China. And that probably means a prolonged weakness of the economy in China, as we've been seeing this year, which means that there is continued potential pressure on the Chinese renminbi, and which the Chinese authorities will try and fight.
How much of, I'm going to bring right back to the Trump trade here, how much of the Trump trade is going to show up in some of that EM currencies? The idea here that you might have weakness in the peso, weakness in the Brazilian real, and again, bring it full circle to that carry trade. Does the Trump trade get in the way of the carry trade, or does it help it?
I think it depends in what you're talking, which country you're talking about.
Take your pick.
So, for instance, if you look at Mexico, Mexico is now the biggest single country importer to the US for goods over and above China. So from that point of view, there are countries that are going to benefit from the stresses between the US and China. India, for instance, is trying to reposition itself. Countries like Canada, even Ireland, can all benefit from the animosity, shall we say, between the US and China. So there will be changes in terms of growth, production, investment as a function of the US trade. And to some extent, actually, we could bring this straight back to Japan, because Japan is trying to position itself as a collaborator to the US in terms of defense. And we had the Prime Minister of Japan in the US, in Washington in the spring, trying to get investment. We've seen an awful lot of investment reforms in Japan. And that could actually mean that in 2 years' time, we're going to look back at the position of the yen now and say, my God, that was cheap. If those trades sort of work, or that investment reform works.
Okay, Jane, thanks so much for joining us this morning. Jane Foley, Head of FX Strategy at Rabobank. Coming up, we will take a closer look at the markets as we close out the week with Maria Vasilou, Head of Pictet Research Institute. We'll focus on what we've learned this week. We'll also take a sort of step back and look at some of the broader investment research themes that Pictet has been dealing with. More on that shortly. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change, In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in employment.
Former New York Fed President William Dudley and, of course, Bloomberg Opinion columnist giving his view on why the Federal Reserve has no reason to wait to cut rates. We're joined now for a little bit more insight here. Maria Vasilou, head of Pictet Research Institute, joins us around the table this morning. Maria, a pleasure to have you on the program. It's an interesting take that Bill Dudley has there, where he's basically saying the time for rate cuts is now. And that seems to be something that the market has come around to, the prospect of a September rate cut. Whereas previously they were saying, the election risk in November really takes that off the table. Why do you think that transition has happened?
Well, the market is very susceptible to pricing rate cuts. This is really what the market wants to see. However, I'm not really convinced that the Fed should rush to cut rates. First of all, the economy is still relatively strong. We see the recent data really not showing any collapse in growth. At the same time, we don't know what the next president is going to do in terms of fiscal policy. Yeah. And the Fed, of course, has a dual mandate, but I think between the two mandates, they need to emphasize the inflation mandate. And some of the policies that the next president may follow could be inflationary. So they need to be careful there.
Which is why I find this so interesting, because we talk about, I'm just going to go with the two presumptive nominees here. If it is indeed Kamala Harris, and she continues that infrastructure investment story from President Biden, that's going to increase costs. If you have a tariff story on the Trump side, also going to increase costs. To your point, inflation on both sides. And yet it's not showing up in the data. When does that show up? Is that a story that's still 12 to 18 months away?
I think there is a lot of uncertainty about the economic policy of the two candidates, but we have seen how sticky inflation has been, and also at the same time we have important structural changes in the world economy that are also likely to continue to be inflationary. So I don't think it's to the interest of the Fed to cut rates now and have to raise rates again 6 months from now.
Is it the same story for the Bank of England, or do you kind of share this fear that if they don't get on with it now, actually they might miss the window?
Well, the Bank of England is a little bit in a different situation because of the weakness in the economy in the UK. In the US, we're not seeing that level of weakness that should really force the hand of the Fed.
I kind of wonder more broadly whether, and I know central bankers don't like to wade into the fiscal story, the political story, but whether the fiscal conversation needs to be had more within that monetary debate.
I have been a proponent of the idea that there has to be a coordination between fiscal and monetary policy, especially given the role that the Fed and the major central banks are playing since the Great Recession because of the holdings of government debt they have, and effectively they are marginal buyers of their country's debt.
Maria, can I take a little bit of a step back from the sort of day-to-day news and focus in on a couple of the topics that you cover with your research? Because actually the first one of these really does link into the Fed conversation, and that's around US debt sustainability. When we came into this year, there was a lot of focus on, well, we're going to have a lot of supply, and that's going to be one of the things that guides Treasury markets, and it has been a factor, but there have been other factors, and a lot of the issuance we watch and people in the market say, oh, well, lots of people bought it and it was well covered. What do you think we need to watch on debt sustainability that the market doesn't pay enough attention to?
What we need to focus on is how interrelated the world is and how much the rest of the world will have to lose by, any crisis in U.S. debt. When you look at the discussions that happen around U.S. debt in the media, it's very much in the framework of how we would analyze debt sustainability for a small open economy or for an emerging market. But the case of the U.S. is very, very different, and the rest of the world is highly intertwined with the U.S., and therefore the U.S. is effectively the quintessential too big to fail case. So there is a lot of fear-mongering around the debt sustainability in the U.S., but the situation is much more nuanced, and we're having a report coming out in the next couple of weeks really analyzing this story.
So is this what you're referencing, the interconnections then? Is this Japanese and Chinese holdings of U.S. Treasuries? Is that the interconnectedness you're talking about?
It's not just Chinese and Japanese holdings. In fact, Chinese holdings have gone down over time, but it's also the holdings of other assets that the rest of the world has in the U.S., and particularly equities. The rest of the world owns about 40% of U.S. equities if you account also for private holdings, private equities, and so on. And that will be greatly affected if there is a crisis in the U.S. debt.
And it feels like, but there's also I'm going to play doomsday here for a second. Forgive me. Let's say it's first, second week of January. We have that deficit ceiling. The new president, whoever that may be, won't be inaugurated at that point. So the economic policies won't even begin to take shape or early on. What happens? We hit the debt ceiling. There isn't a reaction. If 2011 is any indication, you see a bid into American assets anyway. What's the worst case scenario here?
Well, we may have some, turmoil in the markets, but I think the official sector, both in the U.S. and the rest of the world, has a very high incentive to step in and save the day and really provide a floor to those assets.
When you're a big picture thinker, what makes you hopeful?
What makes me, before becoming hopeful, I think it's important to understand all the forces that are shaping our world. There are a lot of things that are changing on the geopolitical front, on the structure of the world economy, the disruption of technology and AI, the demographics. So I think before we become hopeful, we need to understand the environment in which we will be operating going forward, and also what it means for the way we approach investments, and that's exactly what the Institute aims to do.
Yes, and thinking about those big picture themes, and you mentioned demographics, we get this lesson from Japan about what an aging population looks like. We have fertility rates in Europe and in parts of the emerging world that are actually coming down really, really quickly. What does that mean for economic models going forward then, Maria? Do we need to rethink the models that we operate on? Is it all going to be about productivity and technology?
Exactly. We need to rethink the models we're working with, but also the way we invest going forward, the opportunities that are likely to be ahead of us, but also the risks. And the interconnectivity of demographics, for example, with technology, what it means for growth rates going forward, what it means for inflation, what it means for debt sustainability. So there are a lot of things that we need to rethink. For instance, the concept of emerging markets. This is a very old concept. Does this group of countries still make sense in the way we approach them, or do we need to rethink about them? And so this is really what we aim to do at the Institute, and hopefully we'll have the opportunity to discuss some of our reports in another opportunity.
You've had a couple of buzzwords there: inflation, debt sustainability, demographics, and they all, to me, come right back to the Japanese story. And I think right now is a really crucial time to ask that question, because historically Japan, of course, has been the leader and the roadmap almost for monetary policy and arguably fiscal policy around the world. But you're seeing what happens when the demographics do get to that point. To what extent is this some sort of warning? And I'm going to argue this on the debt front as well, because GDP for Japan isn't looking that great either in terms of the debt story. What lessons are we learning right now from Japan that apply to the States, given the size of the States?
This is the topic of one of our reports that will be coming out. And exactly, we view Japan as the case study for the rest of the world. What is happening in Japan, we're going to see it also in Europe and in other parts of the world. So certainly there will be important lessons. But I think it's also important to think in terms of the interplay between technology and demographics, and also different sources of energy that exist, and what that means for the mix of growth and inflation going forward.
Thank you very much, Maria. Thanks for joining us. Really good to speak to you. Maria Vassiliou, head of Pictet Research Institute, and hopefully we can touch more on some of those bigger themes, those long-term themes in the future. Let's have a quick look at where we are on the markets, though, at the moment, this Friday. What are the stocks that are gaining? And we have a strong lineup for you here. Let's start with Drax in the energy business. Pre-tax profits coming in ahead of estimates. We've also got, I think that is NatWest in their second year, up by 7%. What does it mean that the sale of the remaining stake by the government might go to institutions? Does that mean it doesn't go at such a discount? And they upgraded their guidance. So those two drivers there. EssilorLuxottica, we watched news flow around Meta, and Eni in focus as well, also raising guidance there. Let's have a look at the losers as well. Capgemini cutting its full-year revenue forecast. ThyssenKrupp in focus, falling after a warning from that business. BASF profits falling after the chemicals giant faces a drop in prices. And we've got Mercedes also in focus, walking back its outlook around EVs and China. Coming up on the programme, the Olympic Games are set to light up Paris with the opening ceremony due to take place later today. We'll speak to the CEO of the French food giant Danone. That conversation coming up shortly with a big sponsor of the Games. That exclusive interview is next. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
We have different recipe. 500 recipe has been made since 2 years for the athlete. We are there to help them to win a medal, you know.
The Olympics is a net positive, you know, the world has its eyes on the country, and business-wise, I think it can only be positive.
Everyone is coming to Paris for the Olympics, so of course it's a unique opportunity to meet. I think as CEOs and sponsors of the Olympics, we are used to discussing, but everyone wants to have fun and celebrate the Olympics.
We know that more tickets now, there's a record that have been broken here because more tickets have been sold than in Atlanta, which was the highest world record. So we can say this morning that we've already have achieved a world record.
So those were some of the French business leaders we've been speaking to on the build-up to the Paris Olympics, which begin later today. The unconventional opening ceremony is set to take place along the Seine, with more than 10,000 athletes due to take part in the Games across 19 days of competition. Millions of spectators expected to attend. And Bloomberg's Caroline Conan is with us in Paris, joined by one of the sponsors.
One of the big sponsors, actually, one of the big French sponsors, and it is Danone, one of the biggest food company in the world. I'm very happy to be joined by the CEO, Antoine de Saint-Affrique.
Good morning.
Good morning. So you're a big sponsor of these games. Obviously, there's been a very good mood in the lead up to these games over the past few days. But just now, we've learned that there is a big disruption at the SNCF train lines. Is someone trying to waste the party?
Well, I mean, it's obviously extremely sad that some people are trying to take the Olympics hostage or trying to pop the party. It will not happen. Actually, if you look at the mood in Paris, if you look at the beauty of the site, if you look at the enthusiasm of people, I mean, the party is on. So sad attempt, unacceptable attempt, but the party will go on, and it's going to be a fantastic party.
We're about 10 hours from the opening ceremony. Are you going to attend the opening ceremony?
I will be in the opening ceremony, and I'm very, very much looking forward to it.
Obviously, you're the CEO of Danone. Eating healthily is very important when you're an athlete. As a sponsor, you're going to provide fresh dairy, plant-based products to athletes. You're also going to have dairy takeaway kiosks in the different venues of the Olympic sites. Can you tell us which products are going to benefit the most, which products you are trying to put forward internationally?
Well, obviously, first and foremost, it's the Danone brand. I mean, it's telling the story about Danone. It's telling the story about what Danone is doing. Danone is doing health through food to as many people as possible and doing it in an absolutely yummy way. So you'll see right next door in Gare Saint-Lazare a kiosk where people going off the train can experiment yogurts. You'll see in the Olympic Village products for the athletes and even for the French athletes, some very, very special products that we have developed to make sure that they win some gold medals.
Oh, so you do have reserved some products for the French athletes so they can win. What kind of products are they?
So, I mean, we've worked with athletes, actually. We've developed 23 new products for the Olympics. We have developed, in particular, protein-based products that help muscular recuperation. We work very close with INSEP, which is National Institute for Sport. We work very close with our partners, sportive. And indeed, we have some products, especially for the French sportsmen and sportwomen.
You're talking about high-protein yogurts. You have said that your high-protein yogurts actually are getting a boost from people on anti-obesity drugs. We've seen the recent success of these weight loss drugs, but you're not marketing those exactly as anti-obesity products. Why that? Is that bad for the image?
No, it's not a question of good or bad for the image. I mean, what we do, the heart of what we do is gut health. I mean, yogurt are good for guts. I mean, it's about the microbiome. It's about everything you can do with probiotics, prebiotics, postbiotics. And we are one of the world experts in protein. So we help muscular mass, muscular recovery. We help gut health. That's what we do for a living. And obviously, it works in synergies with some of the major trends, but it goes beyond those major trends.
But you don't want to be necessarily associated with this idea of anti-obesity products, because potentially the side effects of these treatments that could backfire.
Well, I'm not sure that's really the point. I mean, our products are very complementary to the anti-obesity product. They are healthy products. I think 89% of our product have a 3.5 or more health star rating. So we have one of the healthiest portfolio in the world. Our products are helping you digest, take care of your guts, take care of your muscle. So they are the perfect complementary to people that are using those kinds of products, but it doesn't limit to those products.
Are you expecting a boost in sales on those specific products because of the Olympic Games, because of being associated as a sponsor to these games?
Well, the first reason for us to be a sponsor of the Olympic was, I mean, it is Paris. These Olympics that are healthy and sustainable. We are an iconic French company. We're a company that is about health through food, which is about sustainability. So there was an obvious match. So the first boost that we expect is really our Danoners being extremely proud of what we are doing. Then, obviously, it's about the image of the Danone brand. It's about people experiencing how great our products are, how tasty they are. So I hope to convince as many people as possible that we have fantastic product, have them try, have them test. Yes, of course. I mean, we will participate to the 13 million meals that are going to be distributed in the Olympics. You're going to see us all over the city. I mean, you see us with incredible yogurt bars in the station. You see us with Alpro bars in a number of places. You see, and I saw yesterday on the internet, some pictures of athletes eating our protein products. So it's, I mean, yes, obviously it's very good for our business. It's very good for our image. It's very good for the Danoners.
13 million meals served during those games to 15,000 athletes who are actually going to sail down the river tonight for the opening ceremony. This is the short-term impact that we're going to see. Obviously, you're in quiet period, you report earnings next week, but in the longer term, some economists actually say that the lasting impact of the games for businesses could last for up to 10 years after the games. Is that going to be a lasting impact for up to 10 years?
We certainly hope so. I mean, obviously an impact in France, where our brand is very well known and very visible, but an impact throughout the world. I mean, making sure that the Danone brand is known for what it is, making sure also that we keep shining. What is fantastic with the Olympics is obviously, I mean, the Danoners from all around the world have been involved. We had torchbearers in the Danone team. But in each and every of the countries, you had local teams taking ownership of the games, either helping the local Olympics team or getting involved with the Olympics. So you have a resonance that goes way beyond France.
Are you planning an acquisition in the health sector somewhere soon in Europe or in the US?
Well, as you know, we've acquired not long ago in the US a small business in the field of enteral nutrition, which is also something we do. We are a company that also does medical nutrition. We regularly look at the market and at things that are relevant to our business, both from a strategic standpoint and obviously from a financial and economic standpoint.
Finally, we are just a few hours away from this opening ceremony. Did you practice sports when you were younger? And if you were competing in one of the Olympic Games, which one would it be?
So I've been a pretty good skier and I've been doing competition in sailing. But if I have to pick one today, it's obviously Rugby 7. We are very close and we support Antoine Dupont. I mean, one of the best players, if not the best player in the world. He played an absolutely fantastic game yesterday against Argentina. I hope he will bring the first gold medal for France.
Great, Rugby 7, perhaps the first gold medal for France. That was Danone CEO Antoine de Saint-Affrique from Paris, just a few hours from these games.
Caroline, I'm going to have to ask you that question the next time I see you. I feel like you're kind of maybe a winner in the breakdancing category. Bloomberg's Caroline Conan speaking exclusively with the CEO of Danone live from Paris ahead of the Olympic Games. Of course, I have more interviews ahead of the opening ceremony there with the city's accommodation very much in the spotlight. We'll speak to the deputy CEO of French hospitality company Aker. That exclusive interview coming up in the next hour at about 9:10 a.m. UK time. Now, look, the Olympics are very exciting from a tourism perspective, but let's talk about the money behind this, because in addition to some of the excitement around the sponsorships that Caroline has really outlined, you have seen the likes of other hospitality companies, hotels, Air France, KLM, for example, starting to actually take hits on their bottom line because they're worried that what's supposed to be a tourism attraction is actually doing the opposite.
Yeah, absolutely. And we saw from Hermes, yes, their numbers have gone down well with the market this morning, but they did say that the Olympics isn't necessarily a positive in their home market. So there is that sense that when you're as big as Paris, you know, what are you set to gain from hosting the Olympics? So we'll see how that one develops. Difficult to get the kind of in-the-moment data, but as it comes through. Worth lingering for a moment on what Caroline was talking about there, about disruption we've seen to the French railways, because we do understand that coordinated malicious acts have been targeted at various TGV lines, the fast train lines in France. This is according to the French transport minister. We've got live pictures, I think, coming through of Gare de Montparnasse, so lots of those trying to get around France, either getting away from Paris if they're not keen on the Olympics, or maybe other parts of France. In the run-up to the Olympic Games, that could be difficult. We're seeing as many as, I think it was 800,000 people being affected by this.
As reported by AFP, that number. But you say that the economic benefit isn't necessarily yet there. We do have a boost to it from our food editor, Kate Crader. She's recommended lots of restaurants in Paris, the best places to eat if you'd like to alleviate that problem over the weekend.
Excellent. So that's something to look out for if you're going to be in Paris. I think you're taking a trip there.
I am. I'm going to do some live reporting. You know, it's very, very exciting. I'm going to check out one of the games as well.
Will you be watching breakdancing?
I will not. I just learned this.
Kiteboarding?
In the last 24 hours, I learned that there were new categories, and I'm really bummed about it. But what I will be watching is tennis, and I'm very excited about that. There are some really great players, and it's going to be a good time, I hope.
Excellent. I'm off to work out what kiteboarding is, and I'm really excited about the opening ceremony and the games. We'll keep watching it from all angles.
Rumor has it Celine Dion might be returning to the stage in these Paris Olympics. Rumor. We don't actually know.
Okay, that's it for the opening trade. European equity markets bringing us back down to earth. Stock 600 up by 0.3%, though, digesting some of the earnings. A slightly better complexion to those earnings stories this morning, maybe at the margin. US futures also pointing higher this morning. Have a good Friday, everybody. The Pulse is next. This is Bloomberg.
from our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Another hit at Mercedes, the German car maker. The latest report slowing EV sales and weak demand out of China. But by comparison, Hermes, on the other hand, bucking the trend in luxury as Birkin buyers driving a sales beat and a stock rally to follow. Plus, of course, travel disruption in France ahead of the opening of the Paris Olympics. 800,000 people affected. We're going to bring you the latest. In the meantime, let's take a quick look at the European markets map, see how the trade is actually working out in the European story, simply because it really seems to be a function of the earnings picture. You are seeing outperformance in the French index to the tune of about 0.7%. Underperformance, I would say, in the German index. Some of that is really just the Mercedes versus Hermes story. The weightings matter. We're going to dive into the details in just a moment. Speaking of diving into the details, let's talk about the currency picture. Strength over strength when it looks at cable and euro. You are seeing green across the screen. We are seeing a high by 1/10, 128.64 on cable, 108 handle on euro dollar. Also starting to see some strength in the Japanese yen. We're going to dive into a lot of the details. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. There is a lot to digest, but let's start with the earnings stories because we are seeing some very interesting market moves. I want to walk you through some of the main ones here. Nestle is where I want to start. Taking a little bit of a beating this morning, down about 1.8%. Remember, this is the second day that you are seeing weakness in the Nestle stock, but also in the broader consumer sector. Unilever coming down to earth a little bit as well, given that rally in yesterday's session. I also want to talk about NatWest Group here, higher by 7.4%. Now, they did raise their income guidance. That was an expectation as well. We are still waiting to see what that government stake actually looks like. Remember, the UK government has about just shy of a 20% stake in the company that they are talking about releasing to institutional investors. So we're going to talk about throughout the show the shakeout of that showing up in NatWest shares. Hermes as well, the outperformer in luxury. Lately, we haven't been hearing that combo very much, given the weakness in China. And you've seen that weight show up in LVMH and Richemont. You name your luxury company, there is weakness, except for Hermes, higher by 4% this morning. The Birkin bag really coming to its rescue. And lastly, Mercedes paring some of its earlier losses. We're going to dive into the details right now. Flat in terms of trading in the European session. I want to bring in Louise Dudley into the conversation, portfolio manager for global equities over at Federated Hermes. Louise, a pleasure to have you on the program. Earnings are coming in so quickly, I can't even catch my breath, to be completely honest. But I want to get your initial take on the numbers that we've seen.
Yeah, so far at the moment, it's been fairly muted. Actually, we're looking at similar levels of beats and surprises as back to pre-COVID type levels. So that's interesting, whereas over the last however many quarters, we've had a lot more companies beating. But what we are seeing, because of the extreme valuations, is that companies are being penalised more on the downside than we're seeing on the upside. So there is this negative skew to results so far.
It's interesting that we're talking about this negative skew because it feels like, specifically in some of the heavyweights, the focus, I'm going to talk about LVMH, but you see this in other pieces of the market, ASML, Nestle as well. There was a lot of weakness in China that was feeding through. And lately, I want to say in the last couple of days, really, you started to see a lot of companies say, well, now we're seeing weakness in the States as well. So what was offsetting the weakness in China is no longer a dynamic at play. Is that temporary?
I think so. I think, the US is still quite mixed. I think things are still going quite strong. I think the latest numbers are actually kind of quite reasonable. And so we actually expect that the US, and certainly we've seen that in earnings so far, that the US has been a lot stronger in terms of earnings growth. So I think the numbers are something like 4 versus 1 in terms of earnings growth. And definitely China is weak. But again, we are seeing actually some green shoots coming through from China. So maybe the sentiment is starting to turn there. And people are starting to get a little bit more confident in their jobs, in the economy, such that the China weakness that we're seeing from the European companies isn't quite as strong.
But when we talk about buying into that, though, if Europe is, and I'm going to have 3 months ago we had this earnings conversation, and the conversation to dive into European equities, or at least the reason to do it, the bull case for European equities, I'm trying to get my words right here because there's so much to digest, is simply that it's a catch-up trade to the States. So that how much of that is true given the catch-up trade may or may not have already played out? Your thoughts?
So we remain definitely kind of more in the US bullish camp. Okay. So kind of less on we're seeing the resurgence of Europe. Yes, valuations look better, but actually the US numbers, the underlying economy, everything there seems to be a lot better, and particularly with the kind of political environment. And as we go into there, we've obviously had the kind of surprise out of France and that ongoing geopolitical weakness, which is really rippling through the rest of Europe as well, that unsettling, that instability. Yeah. Whereas the US doesn't have that. Either way, depending on which way things go, and obviously, it is somewhat directional at this current time, there's a lot more stability, there's a lot more protectionist measures expected to come in. Very good for US companies.
Oh, you are baiting me with the States. Let's dive right in then. I was really trying to make it more European, but I can't help myself. Let's start then with a valuation question in the States. The criticism of the States, and arguably the European market as well, is that the heavyweights are taking all the cake. Luxury in Europe, tech in the States. But if we're talking about that investment and that infrastructure investment in particular, tech is a big part of that. Do you buy tech right now?
So at the moment, it is some of the biggest names. We obviously have had some big sell-offs. In the near term, we expect some of that rotation to continue. So growth was so strong in June, and we are seeing some of that pullback. But in the longer term, these companies are the ones that are expected to continue to benefit. They are such big benchmark weights, and they do have their fingers in so many different areas that even if the hardware's not working, then it's software, different parts of the supply chain. There are definitely areas in tech that are interesting.
So that's great in a lot of ways, that they're so diversified and they're sitting on trillions of dollars in cash. So some of it's a liquidity play as well. But I'm curious about the return on investment in AI, because that's really the latest leg that has driven the story up. You saw it in Alphabet even. They're trying to drive into AI, but at the end of the day, their advertising is still kind of what they're judged by. That's just one example. But you mentioned the hardware versus software question. What is the time frame for all of this AI front-loaded CapEx investment to finally pay off?
So I think it varies a lot, and I think when you're coming new into a space, there's always going to be more money spent than the initial return. Sure. And particularly if you're a pioneer, you expect some loss making to a certain extent. But there are lots of companies at different stages of integrating it, and they can obviously do it in quite a narrow way, or they can look across the whole business area. So there are definitely some easy wins that we expect to come through in the next 12 months. Gotcha. That is, we're seeing that within financials, within healthcare particularly. Yeah. Maybe some of the longer term, more strategic things that, particularly within industrials, That's going to take a bit longer. And also within tech, there is so much being spent that there are definitely going to be areas that they pursue that don't come to fruition.
So let's dive into the tech conversation more. I think that's the juiciest part of all of this, is that when we're comparing, say, the AI forward path to the adoption of cloud, for example, I'm going to get a little nerdy, but stick with me here. Cloud has been around since the dot-com bubble, and we are still looking at Fortune 500 companies, for example, the S&P 500 companies, if you will, to still adopt onto cloud. That has been a 20-year-long process, and there really have been only two dominant players. You're seeing others try to break into that, but they can't. But that adoption process was what I'm after. If you're talking about the AI story now, are we talking about a stock market rally that is pricing in gains 5 years down the road from now, 10 years down the road from now? Does that set us up for then some sort of correction in the market?
So I think it will be sequential. So I think you'll continue to see gains on an ongoing basis. Different sectors, as I said, have been able to take on some of the gains earlier than others. And definitely for some of the largest companies where it can be most challenging to integrate some new systems, they may have a 10-year plan to do this. They may also be at the same time overhauling their underlying IT systems around data governance, responding to regulation. There's lots of other priorities for companies at the moment. There's also lots of companies worried about, their labor supply shortage issues. And that's taking a lot of bandwidth.
But that eats into margins, right? Give us your margin take here. Where is the crunch? Is it in raw materials? Is it in wages? Is it in subsidies that may be going away in 6 months? Where is it coming from?
So, I mean, we're definitely seeing, obviously, the inflation numbers coming down. We're starting to see a bit more weakness in employment. So we're seeing those kind of normalize. We do, however, expect that interest rates will remain high. So that cost of capital is going to remain fairly high for the ongoing period. Even if it gets cut, it's not going to be rapidly eroded. So I think actually, margins are actually maybe more stable in terms of, and we're going to see more of the headline growth, I think, coming through in the near term.
Yeah, fascinating conversation, Louise. We could talk about this all day, several days, weeks if we can. Louise Dudley, Portfolio Manager of Global Equities over at Federated Hermes, joining us this morning to digest some of the earnings on both sides of the Atlantic. Coming up on the program, I think the main event of today, once we get through this earnings palooza, is going to be, of course, the opening ceremony of the Paris Olympics. We know that accommodation prices are higher. We know that security is higher. We're also getting headlines here that there is some train disruption that could affect as much as 800,000 people. We are coming up live in the French capital with some crucial interviews, as well as an update of what's going on. We're seeing live pictures right now of that train station, one of the train stations, I should say, in Paris. We're going to bring you more and the latest details right after this break. Stick with us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back to The Pulse. I'm Kriti Gupta in London. Now let's go to one of our top stories today. Of course, the kickoff of the Paris Olympics over in France. Today, we are going to get the opening ceremony. But in preparation of that, we are getting headlines this morning. There is travel disruption across France. As much as 800,000 people affected, according to AFP. We're seeing live pictures right now of one of the train stations in Paris. Of course, we're going to keep you apprised of what that security story looks like. This comes in the broader context. Of course, a lot of excitement, a lot of sponsorship, a lot of deals ahead of the Paris Olympics, but a lot of that tourism revenue also at stake as we see some of the bottom lines of these companies that are sponsoring and are very active in Paris, maybe taking a little bit of a hit. Let's bring in our very own Caroline Conan from Paris, who's of course been covering the tick by tick of not only the security situation, but the business behind a really historic Olympics. She joins us live from Paris with a very special guest. Caroline.
Yes, and there's going to be a lot of security, 45,000 security forces tonight at the opening ceremony, 10 hours away from now. But of course, these disruptions on the train network is going to impact a lot of travelers. 800,000 travelers, as you were mentioning, could be stranded, and that could last for the weekend after some massive act of sabotage. Now, I'm joined by one of the big sponsors, is Accor Deputy CEO Jean-Jacques Morin. Jean-Jacques Morin, we were in a good mood for the past few days with this Olympics opening tonight. Do you think someone with these SNCF disruptions is trying to ruin the party?
Listen, I saw that. I don't know so. But what I'm going to tell you is that this is going to be an immense party. It's once every 100 years, and I think everybody is in the right mood in order to make that thing something that will stay in memory. So I'm not too much worried. Whether it rains, whether there is one thing happening here or there, in the end, it will be a great party.
Yeah, the rain is another concern, perhaps, for the opening ceremony tonight, because we see it's very cloudy. It's been raining a little bit this morning here. You're one, obviously, of the big sponsors, one of the biggest hotel chains in the world. A lot of your rooms were actually pre-booked by athlete sponsors, media before the Olympics, but it seems like a lot of visitors who were supposed to come, not necessarily for the Olympics, a lot of tourists have decided to delay their stay in Paris, and perhaps we don't have as many visitors as expected. Are you disappointed?
No, I'm not disappointed. I mean, on the Olympic Games, I think the level of occupancy that we're going to get over the period, the 3 weeks, and then the Paralympics, is exactly in line with what we've been saying, like more than 80%, and we're there. And I think the phenomenon that you get before the Olympic and after the Olympic is in fact happening every Olympics. So it's nothing different than what you see every time here. It's just that people tend to forget.
So does that mean that these occupancy rates that we expected actually to be a bit lower, they were impacted for the first few weeks of July, right, before the Games, because of these people avoiding Paris?
Yeah, I mean, it's a mix of many things. And you know what's happening in the politics, you know what's happening on the weather. Last year we had, great events with Roland Garros. So I think you need to look at that all in all with a lot of intelligence. But I'm telling you, what we were expecting for the Games in terms of people coming is what's happening, and that's what is going to make that thing a big feast.
It seems, though, that the luxury segment perhaps is slightly more impacted. There was this report from Yumi Prestige, which represents hotels that charge at least 800 euros a night. They were saying that through most of July, the booking was down between 20 and 50%.
Yeah, but again, that's the period before the Olympic Games. In terms of pricing, what we've been seeing, is something which is no different than when you get those big events, when you get Salon du Bourget, when you get UEFA. You know, you get the prices and the yield management, which is such that your prices are probably 2 times what they are on the same period without those events. But I don't think this is something different than what you see when you get those big types of events. So listen, I'm a French person who sees the cup half full and not half empty. So I am extremely, extremely positive on what's going to happen tonight.
So how much does it cost on average to stay in Paris tonight for the opening ceremony in a hotel? Because there was also some numbers showing that hotel rates are down more than 40% from their peak rate, which was about 11 months before the games. What's the average price? Is that correct?
You know, I think you are probably right in what you're describing in generic term. When we talk about Accor and the instruction that we've got within our network is that the prices are probably to the tune of a bit more than 2 times what they are on the same period normally. So not something crazy, because in the end, if you push the prices too far off, right, the customer will remember. And what we are privileging about everything is a long-term relationship with our customers.
In the center of Paris, obviously, there's lots of restrictions tonight for the opening ceremony. A lot of businesses, restaurants also have been complaining over the past few days that no one is coming to their restaurants. You don't see anyone sitting at terraces outside because of so many restrictions to get to those areas. Is that also impacting business?
I mean, what you describe is what we all live, so I'm not going to say something different than what you just described. Definitely the security, the fact that there is 45,000 people protecting this environment is creating an environment which is unknown. And so for sure, it does have an effect on the capability of people to move. And so definitely you must have what you described in terms of effect on the neighborhood businesses. That's definite.
You're obviously a big executive here in France. Did you or do you practice sports still? And if you were competing in an Olympic game, which sport would it be?
That's a good one. I was not expecting that one. Listen, do I practice sports? I love sports. I think sports is the kind of values in terms of teamwork, in terms of effort, in terms of always trying to, model what you can do better, that creates a good hotelier. So what sports do I practice? To answer your question, I practice a bit of bicycle, a bit of swimming. I wouldn't say that I'm very good at both, but I'm really trying hard. And in the end, that's what I expect from the team, to do the best with the means that they have.
Not an Olympian yet, but trying his best. Thank you so much. This was Jean-Jacques Morin, the Deputy CEO of the big hotel chain Accor, sponsor of this Paris 2024 Olympics.
Caroline Conan, I think we're all trying our very best to be an Olympian. We thank you so much, of course, for that interview with the Accor Deputy CEO. In the meantime, I want to just get a very quick update here on the security situation in Paris. You are now seeing live pictures of Gare du Nord as well. When we're talking about 800,000 people potentially disrupted, that according to the AFP, it looks like the authorities in Paris saying a massive attack aimed at paralyzing the network ahead of the opening ceremonies over in Paris and the French Olympics broadly. Of course, we will keep you apprised of the situation as we get it. In the meantime, we'll get a quick check on these markets as well. One of the big earnings stories this morning, Mercedes joining the pileup in the auto industry as car makers struggle with stalling demand. We're going to dive into the details next. Stick with us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to The Pulse. I'm Kriti Gupta in London. Mercedes has joined a growing list of car companies spluttering amid weaker Chinese demand, plus a drop in EV sales in Europe. For more on the details, let's bring in Bloomberg's Oliver Crook joining us from Berlin. Ollie, walk us through these numbers.
Yeah, so listen, they gave a pre-release on their volume, so we knew that the sales were going to be down. They were down by about 6%. But what we care about with Mercedes is not so much the volumes. They're not really a volume player. They really want to keep and preserve that margin. So their margins came in at 10.2%, which was more or less in line with what analysts had expected. But you look at across the earnings here. I mean, revenue down 4%. EBIT down 19%, net profit down 16%. Those are really very poor numbers for Mercedes-Benz, but they are poor numbers, yes, but they're also beats from what the street had sort of expected from this company. So expectations were set pretty low, and they managed to beat it. In terms of their outlook, they confirmed their guidance. They adjusted their margin expectations down just a little bit. They still have a cautious view on China, fierce competition there. They're trying to hold out to the top end of the market. What is interesting is that given all the terrible results we had this week, really these car companies were being punished in the market. Mercedes-Benz just turned positive on the session, so really getting away with it today.
Well, speaking of that kind of outperformance, explain that in the context of the bad week. Has it been the same kind of driver to the downside for a lot of these other EV companies? Very quickly.
Yeah, I mean, it was just really brutal earnings. I mean, you look at the board there. I mean, you had Stellantis lost 9% yesterday. Renault lost 7% yesterday. Overnight, the Ford Motor Company lost almost a fifth of its value just overnight from its earnings story, which was very, very poor. I mean, and this is across the board. So this is something that we're watching very closely. So for Mercedes-Benz to come out with some fairly weak numbers and then to say, actually, the market's willing to look past that, that is something that they're going to be very happy about in Stuttgart today.
All right, Bloomberg's Oliver Crook in Berlin giving us the latest on the auto sector as we see that broad weakness. Mercedes, the key outperformer. Coming up on the program, we're going to U.S. politics. Kamala Harris pressuring Israel's prime minister to accept a ceasefire deal with Hamas. We're going to get the latest out of Washington next. Stick with us. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Let's get to your top stories. Kicking off with the markets is another hit at Mercedes, the German car maker. The latest report slowing EV sales coupled with weak demand out of China. Hermes, on the other hand, bucking the trend in luxury as Birkin buyers driving a sales beat and a stock rally. Plus travel disruption and a growing security situation in France ahead of the Paris Olympics opening ceremony. We're going to bring you the latest. Kamala Harris says she pressed Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire and warned him about the death toll in Gaza. Now, the meeting in Washington is their first since the vice president entered the 2024 race for the White House. The comments suggesting a possible departure from Biden's approach to the situation in Gaza.
It is time for this war to end, and end in a way where Israel is secure, all the hostages are released, the suffering of Palestinians in Gaza ends, and the Palestinian people can exercise their right to freedom, dignity, and self-determination.
Let's bring in Bloomberg's Vonnie Quinn out of Washington. Vonnie, bring us the latest kind of takeaways from Netanyahu's meeting with Harris and potentially what may come from his meeting with former President Trump.
Yes, that's taking place in just a few hours in Mar-a-Lago Friday afternoon. But Kriti, yes, there was a massive meeting on the foreign stage, if you like, for Kamala Harris, her first meeting with a foreign policy issue, and it's only day 2 of her campaign in what's become a hugely divisive theatre of war for the United States. And the overtones of what she said will be reaching far and wide into the campaign. She basically said some of the same things that Biden said to Netanyahu, but she also spoke to the Palestinian people and also to the protesters and those who are just desirous of a ceasefire. She said, I see you and I hear you. Let's get the deal done. Even her body language was less warm towards Prime Minister Netanyahu than Biden's would be. They have known each other for 40 years. This is a new connection for Kamala Harris. But it did also give her the opportunity to reach out in some ways to demographics that have been alienated by the Democratic Party in recent months. I'm talking Muslim Americans, for example, and also certain segments of the youth electorate.
Of course, we know that Dearborn, Michigan has kind of been the Achilles heel of some of the polling numbers coming for President Biden before he chose not to run for re-election. Vonnie, I want to go a little bit more into the internal politics of this all. We are in the middle of debate season for the vice presidents and the presumptive nominees on both sides of the aisle. What do we know about the latest developments from both camps?
Well, just in the last few hours, the Trump campaign put out a statement suggesting that they wouldn't actually agree to any debates yet, that it would be imprudent for them to commit to any debates when we don't have a formal nominee yet, which is really something different than what we heard earlier in the week from Donald Trump, who said he'd be quite happy to debate Kamala Harris. In fact, he wouldn't mind doing it more than once on different stages and on different platforms. We had to wait until Thursday to hear from the Harris campaign, Kamala Harris herself telling reporters in person that she would be quite happy to see the split screen, that she wanted to debate him. She said, and I'm quoting, "Let's go." But just a few hours later, again, the Trump campaign spokesperson came out and said, all bets are off the table for now until after there's a formal nominating process. We know that's not coming until the DNC towards the end of August, starting August 17th and on. The first debate had been scheduled for September 10th. It may still go ahead, but as of now, all bets are off the table.
All right, Bloomberg's Vonnie Quinn, we thank you so much for bringing us the latest out of Washington. From Washington, we go to Paris. I just want to bring you the latest and the updates that we're hearing on the security situation ahead of those Paris Olympics, the opening ceremony. About 800,000 people affected when it comes to some of the developments around the train lines. I just want to quote here the French transport minister writing in a post on the X social network, formerly known as Twitter, saying, quote, "Coordinated malicious attacks have targeted several TGV lines last night and will seriously disrupt traffic until this weekend." You are seeing, of course, some of the shots, some of the visuals that we have seen from some of the train stations in Paris as well. This, again, ahead of the opening ceremonies that we are expecting tonight along the Seine. Let's go to Paris and bring in Simon Chadwick, professor of sport and geopolitical economy over at Schema Business School. Simon, a pleasure to have you on the program. What a day to get your insights. Before we dive into the economics and the business behind all of this, let's talk a little bit about the security situation. This is always a risk for any host city that brings the Olympics to their doorstep. What do you think the impact might be, not just going into the weekend, as the French transport minister warns, but in terms of the longer-term effects as the Olympics play out?
I actually think that the attacks that we've seen are kind of inevitable. I posted on Twitter last week about this. The games are taking place in the context of a very, very sensitive environment, not just an external environment, but also an internal environment too. The fractious politics of France, as we've seen over the last 3 or 4 weeks, have played out quite dramatically. And a lot of attention has been paid, if you like, to kind of the hard targets of the Olympic Games. So infrastructure, and where you've got large congregations of people, clearly where it's more difficult to control these things, and perhaps where there's been less attention is on soft targets. And so attacking railway lines that are outside Paris, I think probably falls beyond the scope of the official security measures that are in place. But of course, those soft targets, nobody's been hurt, we don't think, and nobody's been physically affected. But of course, the disruption that this causes is immense. And if we want to think about this in economic terms, you think about all the people who've been delayed and all the people who now need to be moved and all the time that is being wasted. If we think about those official events, if people are having difficulty getting to these events, so the start times of these events have to be delayed, that has scheduling, TV scheduling, legal ramifications for sponsors and so forth. So these soft targets may not seem particularly disruptive as such, but they are incredibly powerful in the kind of wider impacts that they have.
Well, Simon, again, we'll go into the economics of Olympics specifically, but this isn't just a geopolitical situation in terms of, we just had Vonnie Quinn out of Washington talking about kind of the pressures around the Israel-Gaza situation, American politics. You have Ukraine and Russia far more of a touch point here in this part of the world as well. All at a time when the French government is still very much in chaos. Emmanuel Macron talking about the fact that we don't want to solidify who's going to be the leader of parliament until after the games to ensure that there is kind of that continuous or that continuity in French governance. How much of that is actually taking place?
One thing that I would say is the people who are organising the games and the relationship with government, my sense is the French have been incredibly professional, have been thinking very expansively, ambitiously. Keep in mind that for Macron, this has really been an opportunity for France to project itself across the world. And Macron's very, very keen for people across the world, not just to see the traditional France, kind of fashion and culture and the Arc de Triomphe and Eiffel Tower, but also to see a new France, an outward-facing, externally engaged kind of Gen Z type France. And so the French have worked very, very hard at doing this, but I think internally there have been some inconvenient truths building. And obviously those fractious politics that we've already talked about are part of this. And so the national mood has, to an extent, undermined what is now taking place around the Olympics. And that has raised all kinds of issues, not least of those security issues. And you know, we've seen, for example, controversy around the French banning their female athletes from wearing hijabs in competition. At the same time, we've also seen Macron inviting Israeli officials to the Elysee Palace to light Hanukkah candles, and so there has been some, really quite negative sentiment in certain communities across France. At the same time, as you rightly point out, we've got several flashpoints. We've got Ukraine, Russia, we've got Palestine, Israel, we've got ongoing issues around international terrorism in generally, and so this is like a perfect storm for what we're now beginning to see evolve.
So Simon, let's bring it back to the economics, and we've kind of covered the geopolitical and security aspect of this. When it comes to the Olympics, there's been plenty of research, which I'm sure you're familiar with, that suggests that this is actually not necessarily, in terms of a kind of CapEx spend, one that is a profitable venture. And I think great examples have been in previous Olympics, in Athens and in Beijing, even in Sarajevo as well, where you've seen such a front-loaded cost, only for it to not being paying dividends in the long term. How much of this is simply Emmanuel Macron really hitting the world stage in a big way and really putting Paris on the map at a time when maybe people might be a little cautious around the French government and around Europe in general?
For the rational economists of the world out there, there is this view that if you want to make $2, you've got to spend $1. So the return on investment is $1. You spend $1, get $2 back. I think that's a very conventional way of looking at such events, and certainly the evidence tends to suggest if we do use this kind of calculation, most cities, most host venues, at best they're likely to come out even, and in many cases they're actually likely to lose money rather than make money. Where I think we are seeing more benefits, hence some of the countries that historically have, or certainly in recent history, have been bidding to stage these events, there are kind of intangible reputational soft power nation branding benefits. Maybe there's something about national identity and about feel-good factor too. And so that does tend to suggest that there are other ways of measuring the outcomes of these mega events. And if we look to that, an important detail here is Macron didn't bid for the Olympic Games. It was actually President Hollande who bid for the Olympic Games. So Macron took up the mantle once he assumed the presidency. But what Macron does is he's got a very sharp sense of image, of profile, of external reputation, of how people across the world see France. He wants to change France in that sense. He wants us to see France in a different way. Hence this, what seems to be this lavishly funded and really quite extravagant opening ceremony that we promised, because this will be the France that Macron wants us to see. But of course, this comes at a cost. And I guess the question then becomes, is that cost justifiable, certainly internally to the domestic electorate, but also is it going to have the impact on external audiences that you intend it to have?
Then talk to us a little bit about some of the things we're hearing out of the corporate space as well. I'm going to give you a few examples here. Air France, KLM, Accor, for example, they've talked about the fact that because the Olympics are in Paris, you're actually seeing the opposite effect to the bottom line, and actually saying that when it comes to things like luxury purchases, you actually might have some more of those purchases happening on the French Riviera, for example. These are just some of the pieces of rhetoric that we're seeing, that French companies that were meant to benefit from this tourism boost are actually writing it down a little bit. How do you square the two, Simon? How should corporate France be thinking about the Olympics?
That's a really good observation that you make, because I've been talking to, for example, hotel owners over the last few weeks, and bookings in many hotels in France, in Paris, sorry, have actually gone down. In some cases, they've halved. What we're seeing is a lot of French people typically at this time of the year would actually head to Paris for their holidays. You know, they come up from provincial towns, but of course they're worried about crowds. They're worried about being able to see the attractions that they would normally go to see. You know, the Eiffel Tower, for example. They're also worried about security too, so they're just staying away. And this, I think, is playing out more generally around the Olympics. There is a kind of crowding out effect, I guess, in the sense that the Olympics does displace some of the normal economic activity that you might see in a district like, you know, Champs-Élysées, for example. And so, as you rightly point out, is rather than head up to Paris and go to fashion stores in central Paris, why not just go to the Riviera and do that? Much quieter, much easier to access it, much safer. You can do it at your leisure. And so this does raise some interesting questions, I think, not just about the Olympics, but about mega events in general and the way that they do displace economic activity, but also in the way that they undermine economic activity. Because inevitably there is a multiplier effect associated with the Games and associated with that economic activity. So, yeah, I mean, I do think the Olympic Games does have a case to answer here.
A fascinating approach as we talk about what the economic and business benefits are aligned, of course, or perhaps at odds with the security situation that is developing. Simon Chadwick, we have to leave it there. Professor of Sport and Geopolitical Economy over at Schema Business School. A pleasure to have you on the program. And coming up, we stick with the economic and the business story coming out of France, where Hermes is standing out from the luxury crowd with a jump in sales. It's all thanks to their Birkin bags that seem to be defying gravity in the luxury sector. That conversation next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Hermes shares in the green after reporting a sales jump in the second quarter in all regions except China, seeing double-digit growth. Now, the Birkin bag maker weathering the luxury demand slowdown far better than some of its peers. And it's all thanks to the richest, the wealthiest, the creme de la creme of their clients. Let's get more from Bloomberg's Angelina Rasquet, Europe's luxury correspondent in Paris, Andrea Felstedt from Bloomberg Opinion, both conveniently matching in green, I should add. Angelina, I want to start with you and dive into the numbers here. Why is Hermes getting this right when so many of its peers are getting it wrong?
Hi there. Yes, indeed. I mean, Hermes has proved over the quarters to be very resilient. It basically, as you said, caters to the wealthiest customers who typically don't come back on spending as soon as inflation hits. And it's got pricing power, and it's got also long wait lists for some of its iconic products. If you think about, the Kelly bag or the Birkin bag. So all of this really helps Hermès, and they grew overall in the second quarter double-digit growth rates, and most importantly, they grew double-digit growth rates in the two main units, which is leather goods and also ready-to-wear. And also trends in so far in this quarter haven't really changed. So pretty positive all in all.
Andre, I want to bring you in here, and we're looking at shares higher by about 5%. And when we talk about this kind of weathering, it feels like, and I love this fact, that Birkin bags sometimes are more valuable as an investment than the likes of gold, for example, or diamonds, because they hold their value and they appreciate. Is that what this is? Is this simply kind of some sort of broader economic statement, or am I reading too much into this?
It's really, as Angelina said, they cater for the very wealthy, who will spend $10,000 on a Birkin or a Kelly bag. They've also got these long wait lists. Now, what is also interesting is they haven't been completely immune from the wider trends in luxury. So the silk and textiles, which is the silk scarves, the ties, that would typically be a way for less wealthy customers to buy into the brand that they were down, and also watches. So not completely immune from the trends, particularly for those customers who are not super wealthy, who are more comfortable, and they are the ones who are cutting back.
So, Angelina, hop back into this conversation here, because when we talk about this Chinese weakness, this kind of luxury weakness that we've seen spill over, and arguably, I want to ask you about this, but arguably this is something you're seeing in the auto space as well. It feels like in the recent months, you started to hear some of these companies really talk about the fact that the dynamic where Chinese weakness was offset by American resilience, that is now falling apart as well. Is that something you're seeing, not just in Hermès, but in the broader luxury sector? Where does the American consumer fit into all of this?
I mean, at Hermès in the second quarter, what we saw is that all the regions grew by double-digit growth rates, except for the region that includes China. I mean, the U.S. is doing really well. However, for its biggest competitor, LVMH, we saw a slowdown across most regions. I mean, LVMH was really helped by Japan. Basically, Chinese tourists, that's what the CFO said, they've been transferring their purchase of luxury goods from China to Japan, because basically they're taking advantage of the weak yen. So that's an arbitrage that we've been seeing.
All right, Andrea, final word to you here. Does this just get worse and worse, given that this kind of Birkin bag story for Hermès is really defying gravity in the broader sector? When we look a couple quarters down the road, are we going to be talking about the same thing?
Yes and no. This quarter has been particularly painful because it compares with the period a year ago. Do you remember when China had just reopened? There was all that enthusiasm. They would be revenge spending again. That didn't carry on. So as we go through, we're up against easier comparisons. So the numbers will automatically look better. What we're not seeing yet is a sustained recovery from China. And what we're not seeing, apart from Japan, is that they're not traveling to Europe to spend where they typically spend more. That will be the key factor for a recovery in the luxury sector.
See, this is what happens when you do well on your earnings report card. It comes to haunt you in a year's time. Those tough comp sales always get you. Angelina Rascouet, Bloomberg's European luxury correspondent, joining us from Paris. Andrea Felstead from Bloomberg Opinion, both covering the beat tick by tick. We thank you both so much. Coming up on the program, we're going to dive right back into the car space. Some similar themes that we heard in the luxury conversation. We're going to dive into the details on what's been a pretty brutal week for those earnings next. Stick with us. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back to the Pulse. I'm Kriti Gupta in London. Weaker Chinese demand and a drop in EV sales in Europe have hit car makers hard in a pretty difficult week for earnings news out of the sector. I want to bring in Bloomberg's Oliver Crook out of Berlin. Ollie, walk us through kind of a very painful week for the sector.
Absolutely, Kriti. I mean, if you just look at some of the pricing action, what has happened in the stocks this week, it tells you a lot of the story. And some of the moves were actually, Kriti, like pretty historic in some sense. Stellantis was down 9% yesterday. You had Renault down 7%, up to 14 at one point. But really the standout, Kriti, is the Ford Motor Company, down 18% yesterday after their earnings went out. That is the Ford Motor Company losing almost a fifth of its value in one trading session. Pretty remarkable. Same thing at Nissan. You saw Audi, you saw Porsche, you saw Nissan, you saw all these companies also cutting their outlooks. If it sounds bad coming from me, Kriti, have a listen to what it sounds like coming from the CEO of Stellantis, Carlos Tavares.
The automakers are under pressure. The auto industry is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil.
And what's really interesting, Kriti, is that really the macro story and the overall story of the auto sector hasn't really changed that much, but this really feels like the quarter where the rubber is starting to hit the road, where the sort of shifting timeline on EVs, what that means for the model mix is really kicking in. The question of China, weak demand, within the domestic market, but also all this competition. And really the bottom line, Kriti, is there is a huge amount of competition, a lot of companies, and the demand is just not there.
A really painful story, and it's interesting that we're talking about hitting the brakes, pun not intended, on some of that EV transition story. The fact that Carlos Tavares, of all people, said that this is not a short-term story is fascinating. Bloomberg's Oliver Crook from Berlin, we thank you so much. And of course, that pain that Ollie was just talking about, you're seeing it show up in the stock market, and by extension, the DAX has been weaker significantly. The luxury story really weighing on the French index as well, but the underperformer this week has been that German market. This is really the Achilles heel that you are starting to see in terms of the auto story. We're going to keep you apprised of if you start to see a little bit of a rebound the way you are perhaps in some of those luxury stocks. A conversation that may bleed into the U.S. session. Up next, Bloomberg Brief with Danny Berger and Manus Cranny kicking off, or at least leading to the trading day in New York. Stick with us. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Graney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Yen's moment of truth. The latest rally is at risk ahead of decisions from the BOJ and the Fed. Falling out of favor, Apple's iPhone drops from the top 5 smartphones in China. And counting down to PCE, markets await the last round of key data ahead of the Fed. Some breaking news, Manis.
A little bit of breaking news. This is the endorsement probably a lot of people have been waiting for. This is Barack and Michelle Obama endorsing Kamala Harris for president. So it's very, very interesting. There's a video that goes with this. We'll catch up with that a little bit later on. But it's an endorsement, and they say passing the torch from one black president, from the first black president, one should say. And Obama said one of the youngest, of course, Obama was one of the youngest ever elected to the White House.
Yeah, and there had been some criticism in some circles and just some questions over why Obama hadn't endorsed her up to this point. The reporting had suggested that he didn't want to be seen as overseeing her coordination, but it's not just the endorsement that's important here, Manis. There has also been a lot of reporting that behind the scenes, the Obamas have been doing a lot of work. The former President Barack Obama himself apparently has been checking in with her nearly every single day, and he's been a sounding board and checking in with former aides that he thinks can help them.
Look, perception is everything. You know, to get the number of votes that she got on Monday night, to raise the amount of money that she raised within the 24 hours, it's a significant self-endorsement without the ratification, let's say, of the royalty within the Democratic Party. Barack said, we called to say Michelle and I couldn't be prouder to endorse you, and Michelle Obama said, I'm proud of you. This is going to be historic. And of course, Kamala Harris has now joined TikTok. Bit of a competition out there between me and Kamala. I just want to put that out there. I think she's winning. You know, there's no need to get pointed about it. She's tripled her following to 1.7 million.
Yeah, unfortunately.
I'm lagging.
I was going to say, unfortunately, you can't run for president, or I'm sure your TikTok following would be equally as robust.
It's my Bloomberg TikTok, not my personal TikTok that is lit up. But look, it's interesting. She's cutting through everything. This is the whole point. She is taking President Trump, former President Trump, head-to-head. He's got 9.5 million on TikTok. This is about using every single conduit of communication.
And I will just say, Obama draws a big crowd. If he's going to be out there, not just on the campaign stump for her, but fundraising, it is a big boon to her campaign.
Absolutely. There are other things to check. Have you anything left in you? Because you've been wiped out with equities, over 4% down in your NASDAQ this week. You've got to really review both the Fed, the AI, and the US consumer. It's a recalibration. Now, Danny and I have had, oh, there you go, up over 1%. Danny was quibbling over the 0.4%, but we have this reassertion in the NASDAQ this morning, up over 1%. Still, the small caps have outperformed the big caps by 10%. So this rates rotation trade is still very there. Julian Emmanuel at Evercore say, is this correction over? No. Keep an eye on a couple of the other stocks that are on the move this morning. You've got Apple dropping out of the top 5 in China, but it doesn't seem to have injured it so far. You've got, there's the Apple price up 1 1/8 at the moment. On the bond markets, of course, you had that solid GDP yesterday, and that just stalled the steepener. The 7s were taken well, in actual fact, better than the 5s, and we gorged on the 2s at the start of the week. But the big story is, of course, dollar-yen. The ascent of the yen stalled, and it stalled after the GDP numbers yesterday. The bulls are vulnerable in the yen. That seems to be the building consensus. There's a vulnerability if the Bank of Japan doesn't go, and they're not likely to go, is the consensus in the stats, with a hike next week.
It's all these consensus trades that have just gone absolutely washed out over the past couple weeks, yen being one of them, and that, of course, has consequences because it is such a funding currency. And the question, we're going to get into this with our analysts in just a moment, but this idea of, is this just a washout of positioning, or is this a fundamental move that has some legs?
Well, I still think if you talk to somebody like Kit Jukes, and I did on the IB this morning, he said, you're still more likely to see 140 than you are to see 160. And I mean, he has been banging that drum. But this comes down to what is the scale and the pace of the cutting from the Fed, because that will determine whether you want to be back in your carry trades or not.
Yeah, or if you have a President Trump who wants to do something that looks like a Plaza Accord trying to weaken the dollar. So let's get into this. So just to check the current yen level, it's just above 154 this morning. We're going to get the latest inflation data out of Tokyo. That has hit. It keeps the bets alive on a BOJ hike. Let's bring in Bloomberg's Vasilis Karaminas, who joins us now. And Vasilis, Manis and I were discussing this is the question. Is this just a washout of positions that's moved too far too quick, or is there any fundamental juice to continue a yen strengthening?
Yeah, Heather. Certainly we see a big positioning adjustment in dollar yen. It was the most crowded trade in the Z10 currency market throughout the year. What we're seeing right now is a repeat of price action we saw back in November, December, when dollar yen at the time fell from 150 to 140. Now we have the move from 160 to 152 within a 2-week period. At the time was a 2-month period, down to the same narrative that basically narrower interest rate differentials between Japan and the US. This time around, what was also quite interesting, because it came at play at once, all these factors together. First off, we had Japanese intervention coming in, changing the rules of the game, because there was no real volatility in the yen. Again, it was not weakening. Basically, it was a lower US yields play from Japan's Ministry of Finance. Then we had Donald Trump's interview with Bloomberg Business Week, where he actually, raised concern to the market that, hey, maybe an administration by Trump, if he's reelected in November, will pursue a dollar devaluation policy. And maybe his reelection should not be seen definitely as a dollar tailwind due to his inflationary policies. And then the third thing was risk aversion, with global stocks falling, the big carry trading effects taking a hit. So all this together created, this heavy selling in dollar yen, which has, the big fundamental narrative behind it to support it and to fall further. But cautious is warranted, just as we saw last, back in end December, early January. The market gets too dovish on the Fed and too hawkish on the BOJ.
Well, the BOJ wants stability. That's the one thing that they crave, and we haven't got that in either direction on this dollar-yen trade at the moment. The data is driving the bus. The steepener stalled yesterday in the rates market on the back of the GDP numbers, and so too did the yen's ascent. Now, the risk is this for the yen bulls, is that they don't get a hike next week. How important is it for the perpetuation and the momentum of this trade that you get a hike to take you through the 150 level, to that level that Kit Jukes is talking about, 140 rather than 160?
It is important, but to me also forward guidance is equally important, because if the BOJ says, okay, we hike by 10 or 15 basis points and we're done for months, then people will step back and realize that the spread between 2-year Japan and US rates is 400 basis points, and that's a lot to dismiss a carry trade revival in dollar yen. But there's also, again, the BOJ is one part of the equation, and the Fed is the other part. And I think it's pretty risky business right now to go tactically long the yen at these levels. Maybe you need to sit it out until those meetings are done. And because, if in the grand scheme of things, if dollar yen is to fall further, the big level chart is watch out for is 140, and that's really, really a long way.
Vasilis, thank you very much. Vasilis Karamanis there on the dollar yen. The crazy yen trade of the week. Well, here in the US, we just had an undeniably solid GDP report highlighting the resilience of the American consumer and businesses despite continually high interest rates. GDP grew 2.8%, personal spending up 2.3%. But what impact will that data have ahead of the FOMC? The UBS chief economist Paul Donovan says this: GDP fails to capture all of the modern economy, a statistic created a century ago in an era of flappers and Al Capone. Is struggling to include TikTok content and side hustles. Let's see whether his colleague Abigail Watt of UBS, the economist team there, agrees with Paul. Who could possibly disagree with Paul? But when we look at that GDP data yesterday, it was pretty strong. Are you as reliant, are you as believing in the GDP data, perhaps as some are skeptical as Paul?
Look, I think it's one statistic, in a wealth of statistics that you can look at on the US economy. There are elements of the AI story that you can look at within the GDP data. They do try to capture, where some of that investment might be taking place. We can see some of that. And I do think there are kind of some signs in the GDP data themselves around some of that AI investment. We have started to see, fairly strong increases in kind of capital goods imports, and that's been feeding into stronger kind of overall kind of investment in the US GDP in the national account. So we have seen, some signs there of that feeding in. So I'm not sure I would discount their kind of inclusion in GDP. I do think, there are ways in which you can look at those data and see how they are feeding into kind of overall growth in the US economy.
Abigail, I know you see a rate hike in September and December. I gotta say, where that sounds pretty middle of the road, it's starting to sound more hawkish, considering things we've heard from former Fed official Bill Dudley and Mohamed El-Erian saying that the Fed is at risk of more likely increasing the odds of a recession in the case of Dudley if they don't go in July. Abigail, what do you make of those calls, that a recession is likely unless the Fed acts soon?
Yeah, so as you said, we're expecting to see a cut from the Fed for the first time in September in this cutting cycle. We then think they'll follow that up with a December cut. In terms of their kind of characterization recently around the labor market in particular, which is what I think is driving a lot of the kind of debate and discussion around the kind of extent of cuts that we'll see this year, they changed the characterization there a little bit in recent messaging from various members of the FOMC. We heard them kind of shift away from the kind of strong labor market narrative towards this idea that you maybe are starting to see kind of a kind of more slowing in the labor market. And I do think that is an important shift. But the one thing that I would note is if we think back to where we were, after the June SEP was released, we saw kind of 4 members of the committee signaling no cuts this year at all. You saw an additional 7 saying just 1 cut would be appropriate this year. So I do think, in order for for us to see kind of a greater extent of cutting from the Fed this year, I think we would have to see kind of more signs that they're concerned around the labor market. And, in our expectations, we do have a slowing in the labor market, but we don't have kind of an outright stalling that would maybe drive the need for kind of a quicker pace of cuts from the Fed this year.
How much conviction do you have again around the SARM rule? Because the argument yesterday from the discussion on Bill Dudley's piece, et cetera, is that the 3-month average on the unemployment rate rising by nearly 0.5% over 3 months is a justification. It's a precursor to a recession, and that in of itself should be one of the things that's driving the Fed, and that they are reluctant to accept that. How much of a driver is that for you and the team?
Yeah, so we wrote recently about the SARM rule, and I think the nice thing about the SARM rule is the fact that it can capture some of the non-linearity, you know, the speed with which the unemployment rate is rising kind of matters. But the other thing to think about is the fact that if you continue to see the unemployment rate just eking higher slowly, you know, you could be in an environment where you don't actually see the SARM rule trigger, right? So I think one of the things that I always say is that, you know, this is one input into the Fed's thinking alongside a wealth of other labor market indicators. You know, they'll be looking to see kind of what we see in the payrolls report next week, you know, the kind of JOLTS data, what's happening in terms of openings and quits rates, and what's happening in terms of kind of hiring rates in the US economy. There's a whole wealth of data that they'll be looking at, and I think the SARM rule is a useful indicator, but it's one of many things that they can be looking at when they're thinking about their decisions.
Yeah, even Claudia Sahm herself has argued against putting too much weight in the SARM rule, so I think that says something. Abigail, you talked about some of the metrics that you care about. How much do you care about this earnings season when we hear consumer-facing companies over and over issue warnings? Everything from plane makers to autos to the discretionary, we knew that was a problem, but to staples too. What difference does that make to you?
Yeah, so I think obviously you can look at the micro level where we were looking at GDPs yesterday. We can look at the micro and we can hear what companies are saying around the state of the US consumer. And I think it can be an interesting input into kind of thinking about what the US consumer will look like going forward. You know, we've been saying for some time that we think the US consumer is going to slow this year. And, you know, we have seen some signs of that. Consumption was fairly robust in the GDP data yesterday, but we, you know, are expecting that we see, you know, consumers coming under increasing pressure. And in particular, one of the things that we've been looking at on the consumer side is this kind of bifurcation between those consumers at the upper end of the income spectrum who are still sitting on relatively healthy balance sheets relative to those at the lower end of the income spectrum who are perhaps showing more signs of stress. So I do think there is kind of a slope for a further slowing in the consumer from here in the US.
Okay, Abigail, we appreciate it. We'll see what the numbers today bring. Abigail Watt of UBS. Okay, let's get to some of the other top stories trending on the terminal this morning. China is considering a fee hike of at least tenfold on high-frequency trading. The country has been trying to rein in some quant strategies. Regulators see them as a threat to fairness in the nation's stock market, which is dominated by retail investors.
Hermes defies the luxury slowdown. Sales jumped in the second quarter. The Birkin bag maker is weathering softer demand better than its peers, thanks to its strong pricing power. It did see softer demand for its more affordable goods, such as silk scarves.
I'm still waiting for Manus to give me my Birkin. Anyway, Moody posted second quarter inflows that surpass analyst estimates. It also helped lift its assets under management to now $2.3 trillion, a record high for them. Inflows at the Paris-based asset manager were driven by medium and long-term products. Its treasury products saw outflows as corporations withdrew cash to pay dividends.
I can get you an aspirational luxury product, but not a Birkin. Not a Birkin.
I'll take what I can get.
Coming up in the show, Apple's iPhone isn't even in the top 5 in China anymore. It lags the local Android brands that proved to be more popular.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Apple has lost ground in China's smartphone market, falling out of the top 5 most popular. Meanwhile, local companies like Huawei have surged ahead in the quarter up to June. For more, let's get to Bloomberg's Tom McKenzie on this. Tom, how should we understand this? Because the data feels as if it's been uneven. Sometimes we hear data that Apple isn't shipping many iPhones to China, and then they themselves in their earnings say that it's somewhat healthy. So what do we make of this?
Yeah, it's a mixed picture, but what it underscores, I think, is a trend that we've seen reiterated over the last few months for Apple, which is that it does not have that glide path, that easy glide path to growth in the Chinese market that it once did. And you're absolutely right, the data has been mixed. You get the government data, and then you get the data from research firms like IDC. Their numbers coming out today with that 3%, more than 3% slide in the second quarter. What's really important is that that 3% slide for Apple compares with 11% growth for its competitors on the Android system, the likes of Huawei, Vivo, Xiaomi, and Oppo. So the competitive strength continues as a challenge for Apple. And as you rightly pointed out, what this means is they've fallen out that top 5 handset maker, smartphone maker in the Chinese market for the first time, by the way, in 4 years. We did see details coming through in terms of shipments from the government data suggesting that things were picking up. So it's a bit of a volatile data picture, but the top lines are, this is a consumer base in China that is challenged. You link that to the real estate sector. They have less money to spend on some of these premium items. They are cutting back. Consumers are feeling under pressure in China. Then you have the competitive threat of the likes of Huawei that just becomes more acute for Apple, and it just becomes that much more challenging for them. Of course, Apple's betting on their AI products coming through. They still hope to ship about 90 million additional iPhones by the end of this year. And then they're looking to other markets like India, where they've seen a 33% or so increase in revenues most recently.
Yeah, well, an awful lot is being banked on that AI upgrade. If you think about it, I just spent whatever on a brand new iPhone when I came to live here last year. Is AI going to take me up over the hill to bang out another $1,000 on a phone? I think it's $1,000 for a phone. Anyway,
Something like that.
Something like that. Sunglasses, Luxottica, it looks like Meta. They've had a close relationship with the maker of Ray-Bans for a number of years, but now we understand they want to try and be a bit more formal, and Meta maybe take a bite and a chunk of Luxottica. What could be behind that?
Yeah, absolutely. Look, I should also say, Manus, you have a couple of options now in terms of the gifting to Danny. If you can't get the Birkin, they go for the iPhone 16 with the AI.
She's
or go
getting
for
a scarf.
some Meta glasses from Ray-Ban and EssilorLuxottica. Look, we've done some reporting about this previously, suggesting that Meta might be taking a 5% stake. Today, the CEO of EssilorLuxottica came out and said that they are looking to take a stake, Meta are, and this is the world's biggest eyewear maker. This is about augmented reality, and it's about getting the AI components and some of Meta's hardware into these glasses. They already had the Ray-Ban Meta out in 2021. It looks like they're going to build into this. Apple, by the way, going back to the Apple story, they have the Vision Plus Pro headset. Meta and Apple going head-to-head in that space, and Meta taking this stake. It looks to be, at least, hasn't been confirmed, in the world's largest eyeglass maker.
We're all going to look good in our new Ray-Bans. Tom, thank you very much. She's getting a scarf, not a Birkin bag.
Ooh, I'll take it.
Tom McKenzie there. We're going to talk a little bit about what JP Morgan are doing with the in-house GPT chatbot. That's next on Bloomberg.
names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Front Page Friday. This is what we've got for headlines around the world. Let's kick it off with the Journal. They've got reports that the U.S. intercepted Russian and Chinese warplanes this week. The U.S. and Canadian fighters intercepted 4 warplanes 200 miles off the coast of Alaska. Danny, that was on Wednesday, marked the first time strategic bombers from 2 adversaries have operated together near North America. The Pentagon chief expressed concern. Understatement.
Meanwhile, the Washington Post leads with this. Harris has called for ceasefire and hostage release after the Netanyahu meeting. Yeah. She appeared to add pressure on Israel and Hamas to close the gaps in reaching an agreement, and notably, she gave the address instead of President Biden.
And she really made a play for saying that, she heard the protesters. So this is a shift. Now, how's your wealth management and your asset management? FT leads with this. JP Morgan lead the charge with a chatbot, an in-house chatbot. This is for the AI across research, and you treat it as, I suppose, a very hard-working intern.
Well, see, this worries me because they say it can do the work of an analyst. This is such an important part of the financial pipeline. You have these analysts who come in. Yes, it's grunt work, but they do it, and they eventually rise up in the bank or go elsewhere. What happens if that's all replaced by bots?
Well, the one thing about grunt work, or the stuff that you do early in your career, it solidifies your knowledge, it builds you into a much more robust risk taker or detractor of risk. We'll debate that in a moment.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Yen's moment of truth. The latest rally is at risk of snapping as investors brace for rate decisions from the BOJ and the Fed. iPhone's China struggle. Apple loses its spot as the nation's top 5 smartphone makers on quarterly shipment slip. And counting down to PCE. Markets await the last round of key data ahead of the Fed decision. Danny, good morning. Bounce back, NASDAQ.
Yep, but the rotation is still alive and well. Even with the NASDAQ that's up, we'll call it 1% this morning, Manus. Your Russell 2000 futures, they're up nearly 2%. So we're still seeing the rotation, but it's different this time. It's not everything falling, it's everything gaining, and small caps outperforming. The S&P, your future session, up almost 1%. This thing has fallen for 6 out of the past 7 sessions. Your Mag 7 have fallen 13% since their peak on July 10th. In the meantime, Russell 2000 futures outperformed, up a 24 percentage points. That is a big change. Meanwhile, even despite the strong data we got yesterday, there has been yields falling. We're down barely half a basis point this morning. We're at 4.23% on your 10-year yield. But man, is Bank of America just out with their latest research from Michael Hartnett saying that we are one bad payroll away from the end of tech dominance.
Yeah, and he does make this point. He said that stocks could flash a contrarian sell signal if we go for breadth. And the one thing that pretty much every guest that came in and sat on the end of this desk since the start of the year has been waiting for that moment of when they go for breadth. In terms of the wipeout, you gave the percentage. In terms of the dollar valuation of the wipeouts from the July 10th NASDAQ high, it's $2.8 trillion. It's $2.8 trillion of wealth, $2.6 trillion of wealth destruction.
Well, part of what Michael Hartnett talks about is the recent data has indicated that we're on the verge of what he calls an ill economy. I don't know. It's very confusing because you could look at the GDP data yesterday and say this is an economy that is strong. And this is inflation.
And personal spending's up as well.
Yeah, exactly. The consumer is strong despite some weird flex in earnings, which we can get into. But it's a really choose your own adventure market. Depending on what data you see, it's either an ill economy or still a strong one.
But if you think of the past week, you've had Dudley calling for go now, go early. You've had Mohammed El-Arian talking about, you know, you're 2 steps away from a mistake. But here we are. Again, this is the 3rd shoe to drop this week. We're one bad payroll away from this whole momentum ending. And a number of guests yesterday and across the week have said, look, we're not done with this sell-off yet. From Julian Emmanuel through to a number of others. We are still under pressure in this market.
Yep, but Michael Hartnett writes that the bulls are holding on to the belief that this is simply but a healthy correction. Well, let's get the view of Clear Harbor's Aaron Keenan. He weighs in on some of these market uncertainties, writing, we are entering a period of historical weakness for markets at a moment when consumers are on their heels and employment tailwinds are disappointing. Aaron joins us now, who is the CEO of Clear Harbor Asset Management. Aaron, it is this divide between those, as Michael Hartnett points out, that believe this is simply a healthy correction or something that has legs and can go further. Which side are you on?
Well, we'll have to see. I mean, I think clearly the rotation that you referenced at the top is still afoot. We're seeing in the futures this morning, Danny. And I think that's to a great extent a function of the belief that the Fed will cut rates no later than September. And perhaps, you know, the history of rate cuts isn't that they cut and they wait and they cut and they wait. It's often they cut and they cut more significantly because the economic tectonic plates have shifted. And so we'll have to see if that starts to price itself in the market. But we've certainly seen sort of two-sided economic data that is making the Fed's decision a bit challenging as we move into the late summer and into September. You have the jobless claims trending upward, and you have a lot of consumer data suggesting that, yes, well, that some of the data suggesting consumer strength is there. A lot of that is across staples, the necessary goods that need to buy that are still at elevated levels on the margin, rather than things like autos, which we're seeing a rise in delinquencies. Credit card lines of extension are trending higher and defaults are increasing. And so there's certainly some strain on the consumer at this point. I think the Fed is taking note of that.
I mean, when you look at this week, good to see you this morning. When you look at this week, Ford down 18% yesterday. Okay, could be idiosyncratic, but the airlines also saying, warning about bookings. You're looking at Nestle. We're pushing back in terms of prices. You know, what kind of slowdown is beginning to materialize?
Well, we'll have to see. The GDP data was strong, but obviously that's often a, you know, sort of a in the rear view type of scenario. If you look at the beige book out of the Fed, it's indicating, you know, certainly some significant slowdown around the country in economic activity. Earnings were about 40% through the S&P 500, and only about 40-odd% have met or exceeded top-line expectations. And so that's a relatively historically low number. I think I think Bloomberg indicated yesterday that's probably at like a 5-year low of beats at only 40-odd%. So this is not just a consumer staples story. This is also, as you know, a technology story where we saw Alphabet. Yes, their earnings were relatively strong, but R&D spend is a big question, and the return on that investment is starting to impact how investors are thinking about things. If you look at mega cap tech trading at 30 times, that's expensive, but the rest of the market's trading at about 16 times. And if you look at, you know, the 4 technology stocks in the S&P 500 are driving the technology return year to date, which is about 22%. About 50% of that return is being driven by just 4 names, and there are 66 names within the technology segment of the S&P 500. So that's not necessarily a bad thing. That can be a good thing. That can suggest that there are things under the hood that are not trading as expensively that could start to gather some steam, and we're seeing that, of course, with the Russell rotation, which has been massive.
It's been massive, Aaron, but can it be sustained if we are worried about the economy, if we are worried about a consumer that is slowing down? Because a lot of the companies in this index, sure, they benefit from rate cuts, but they do not do well in the case of an economic downturn.
That's right. I mean, certainly a recession is going to impact the S&P and the Russell. And but there's also a change afoot here, too. We have an election coming up, and I think part of the Russell narrative is partially a question around tariffs and whether or not the import price piece will increase, allowing for a lot of these domestic manufacturers and domestic service providers, which are heavily represented at Russell 2000, to, you know, capture a bit more demand here in the United States. And I think that's, you know, part of the narrative. Not to mention the Russell is very cheap on a historical basis, and the S&P is quite expensive. And so, you know, so we'll have to see. But the Russell since July 5th has rallied about 10 percentage points, and the S&P is off about 3 percentage points. That's a 13 percentage point gap there, and it's continuing again this morning, and it continued again yesterday.
Look, one of the big themes that we've been tracking through the week has been the reverberation from the yen trade, from the carry trade. And it's not just been in the FX market, it's been in gold, it's been in Bitcoin. The narrative is the funding currency of choice is now dislocating many other assets. You look at gold from the perspective as being something that can ballast against deficits going into 2025. So when you see drawdowns in gold like this, along with the equity drive-by, What does it say to you? Is that an opportunity to pick up other havens as well as bonds?
Yeah, I still think gold's a reasonably good diversifier in this moment where our deficit spending, both here in the United States and around the developed world, is very elevated. In the United States, it's at World War II type levels at about 7% of our GDP. I mean, that's insane. And both candidates for president are not talking about this, and they need to. And so it would seem as though this challenge around deficit spending is going to continue. That QE may come into play again. That the irresponsible nature of the U.S. Treasury is coming to the fore. We here at Clear Harbor look at gold as just an alternative currency. It's just not manipulated to a great extent by central banks like a fiat currency. And so we just think about gold in that context. And we think when there's irresponsible deficit spending in the world, when there's QE, and when we're running deficits at 7% debt to GDP with no end in sight, we think gold is a reasonably good diversifier and a piece of ballast that needs to be represented, or at least should be considered in a portfolio.
Okay, Aaron, thank you so much for being with us. That's Clear Harbor's Aaron Cannon on the markets. Coming up, airline stocks rallying after the results from American and Southwest. Is there pressure in the sector underneath the wings?
Meanwhile, over in Washington, the Obamas have officially endorsed VP Harris for president just 40 or so minutes ago. Here's the video the Harris campaign has released.
Kamala.
Hello. Hi.
Hey there.
Oh, hi, you're both together. Oh, it's good to hear you both.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the open.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranley alongside Danny Berger in New York. So the latest airline results show an industry that's facing pressure to cut prices. You've got delays on aircraft deliveries. You've got rising costs. American Air is just the latest to cut its outlook. Next week, we're going to hear from JetBlue, Allegiant, and Sun Country. For more, let's get to our aviation reporter, Sid Phillips. So, Sid, look, American, you could say, has had a couple of missteps, but there's a theme here. Ryanair in Europe say that they're having to cut prices. American are trying to aggressively rebuild their relationship with corporates. How bad is it from the demand side?
Morning, man. So there is a demand. Demand continues to be around, but the price is, it's about ticket price and when will people be willing to pay for tickets. And I think that's where the airline industry is sort of struggling in terms of yields, because American, Southwest, all of them have had costs that have risen sharply in the past couple of years. And at the same time, passengers aren't willing to pay those high fares that they were willing to in their sort of rebound from the pandemic. And that's where the airline industry, especially the carriers in the US, because there's a glut of capacity in the domestic market. So you've got the likes of sort of Southwest, you've seen American cut its outlook twice for the year. And that's all based on the fact that there isn't, people aren't willing to pay as much, and airlines are being forced to discount tickets in order to fill those seats up.
Yeah, it feels like a shift that happened so quickly, Sid, because it was everyone and their mother was going to Europe or Japan. Sid, we appreciate it, Bloomberg, Sid Phillip. Okay, over here in the U.S., we have some data on tap. We're going to get June PCE at 8:30 a.m. New York time. We'll also get personal income and spending numbers, which should show some household finances that are getting stretched. Bloomberg International Economics and Policy Correspondent Michael McKee joins us now. Mike, just set us up. What are we expecting?
Well, we're expecting good news. We saw yesterday the GDP numbers that the spending numbers were probably going to be reasonably good, up from last month, 0.3 compared to 0.2. But it's going to be an interesting day because you look at what's supposed to happen with inflation, expected to continue to ease and come down. But here's the dilemma for Wall Street. Inflation goes down. Oh, the Fed can cut. Spending goes up. Oh, the Fed better not cut, which was kind of the reaction we saw yesterday. So it's going to be really interesting to see. And this is going to be three-digit Friday, because we see a forecast for 0.1% on headline and a 0.2% gain for core, but it depends on rounding too. So if numbers round up, we could see a slightly higher than expected inflation number. It'll be interesting to see how markets react to that.
It's interesting because the cover that they need or that they want to give them the more time was evident yesterday in the GDP and in the spending. And maybe if this just comes in line, it gives them that window for anything else that can happen in this next 6 weeks.
That's basically what the markets are thinking at this point. We've pretty much priced in 3 rate cuts over the course of the rest of this year and then into 2025. That's fairly aggressive. Do they need to do that? I don't think the Fed is, along with the markets, that far out. But we'll see today if we get any kind of reversal in market thinking about where we're going to be based on what we get from the spending versus the numbers on inflation. Also, we get the University of Michigan at 10 o'clock with the inflation expectations numbers, if those are kind of out of line. But we're right now where the market thinks and where the Fed has said they want to be when they want to start cutting. So
okay. As you say, it's a pretty punchy assumption by the market in terms of the trajectory for cuts. Mike, thank you so much. We'll count down to the data with Mike McKee on surveillance a little bit later on today. Let's get to Paris. Guess what? The trains to and from the capital were hit with what authorities called a massive attack aimed at paralyzing the network of France's super fast trains, just hours ahead of the opening ceremony for the 2024 Olympic Games. Caroline Conin is in Paris. Caroline, allez les bleus. That's what we'd say to you. But look, this is the last thing that France and Paris needs. 800,000 customers possibly delayed getting to Paris for the Games. Just tell us what's happened on the TGV and how serious an impediment is it to this opening ceremony?
I mean, it is pretty serious given we're just a few hours away from the opening ceremony, which is going to take place right here in the city along the Seine River for the first time, not in the stadium, but in the city. As you mentioned, as many as 800,000 passengers could be stranded. The TGV lines that have been affected are going towards the west, the Atlantic coast, the north towards north of France and towards the Eurostar to London, and the east towards Belgium, Germany. All these lines being affected by some coordinated sabotage. The southeast of France going towards the French Riviera has not been affected because the SNCF agent managed to catch those activists who were trying to damage the rails. I was talking to a few CEOs this morning right here, Accor Deputy CEO, Danone CEO, who said that it is very sad that some people are trying to take the Olympics hostage, but it's not going to ruin the party. The party tonight right here in Paris expected along the Seine River. As many as 6,000 athletes are going to sail down in boats with a big finale at the base of the Eiffel Tower.
I gotta be honest, Caroline, it seems every trickle of information we get about the Paris Olympics hasn't been great. From this to just the demand that doesn't seem to be as good, whether you look at local businesses complaining or ticket prices for, not ticket prices, hotel prices for rooms lower than they had been at their peak. Is there a demand issue?
As many as 15 million visitors are expected in Paris during the Games, but as you mentioned, there's been some concerns because those tourists, those wealthy tourists who usually come to Paris during summer have been avoiding the city if they are not attending the Games. So the peak rate, for example, for hotels, which was 11 months ago, we're down about 40% from that peak rate in terms of average rate for hotels in July. Also, the airlines Air France, KLM, who's also a sponsor, has warned about revenue shortfall of as much as 200 million euros because of those tourists not coming if they're not attending the Games. But then, obviously, you have those businesses who are benefiting. I was talking to Accor this morning, big sponsor. They are at 80% capacity, which is better than last year, about 10 to 12 billion euros. This has been the cost of these Olympic Games, and according to some economists, in fact, this could have an impact on GDP of 10 billion euros as well. And the effect of the Games on the city, on businesses, on economic activity could last up to 10 years.
Caroline, we appreciate it. Enjoy the Games. Bloomberg's Caroline Conan in Paris. And later today, speaking of hotels, Airbnb CEO Brian Chesky will be on at 10 a.m. in New York on some of that lodging demand during the Olympics. Mans, let's get a quick check on these markets because the rotation is alive and well. This morning it's taking the form of everything, of all boats rising in this tide, but Russell 2000 futures up 1.5%. We're just catching up with Aaron Kennan of Clear Harbor Asset Management, who said that this is not just an economics trade, it is a tariffs trade for local businesses, local manufacturers that benefit off the back of them.
Yeah, but then the kind of argument of that is, of course, you've got the Russell to the big tech outperforming, but if there is a harder landing, as you say, that's when the trouble may brew for the Russell. Coming up on the show, it's Friday, so we'll set the agenda for you for the rest of the day and for next week. Context matters every day on Bloomberg. What a beautiful dawn.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief on this Friday. I'm Danny Berger alongside Manus Cranny in New York. Let's get you set up for your trading day now. We're going to get a lot of data, U.S. personal income and spending, plus PCE. All of those come out at 8:30 a.m. Eastern. That will be followed by the University of Michigan Consumer Sentiment. That comes at 10 a.m. Plus, we're going to close out a busy week of earnings where a third of the S&P reported. We'll get 3M, Bristol-Myers, and Colgate. Manus, all of those report before the bell.
Okay, well, all eyes down on those. Now, there's a couple of individual stocks which are certainly worth keeping an eye on. And this is actually a turnaround. We started the show with the NASDAQ up about 1%. That momentum has improved. NVIDIA's up 2.4%, turning it around. ADM up 2.7%, and Broadcom. So again, the chips are leading. I think what you've got here, Danny, is a week of reflection, which is the Fed, the timing of the Fed, the AI trade, that big AI trade, and of course the consumer. And then if you think about what Bank of America have said, I really, really like the line, which is, we are one, this is Hartnett's note, Bank of America, Hartnett's note, we're one bad payroll away from, the big tech dominance ending. That's quite a call.
It is, but I have to say most of the calls around tech have centered on the fundamentals, and that's part of the reason why this rotation trade has picked up some steam, specifically with Alphabet earnings. Because you have this idea that they've spent more than $350 billion in R&D just this year, just in the first half of this year, in order to get that AI capabilities built in. And investors are going to start looking at that and saying, if you don't monetize that, if there's not a clear path to that of profitability for that, you've overspent, and we're not willing to own these hyperscalers. Again, we're going to get more tech earnings. You could possibly argue that that would be more damaging for tech names than the payrolls.
Well, all of their capex are going to rise, probably. That number in Alphabet is up by 80%, $13 billion, up 80% from last year, and that's really what shook the market. In terms of the differential between the Russell and the large cap, and our last guest just said this, is that you have the Russell rising by 10% since, the space of July, since the start of July, and the S&P down by 3%. So that trade is not dissipated. This is about a couple of big rotations in bonds, in yen, and indeed, a big tech to Russell.
I was going to say, part of the thing that's probably giving us relief this morning is that we don't have another session of yen appreciation. It's little moved this morning because it is a very normal trade to be something like short the yen, but also long treasuries, and at the same time, long U.S. equity. So you get a little bit of relief there, and then does it unwind further if we get a BOJ that doesn't live up to hawkish expectations?
Well, the yen rally stalled yesterday on the stronger U.S. data. You're counting down to a Fed meeting and the BOJ, and still the punting is not that the BOJ will hike yet. So maybe yen rally has run out of breath for now. Surveillance is up next. Good morning from New York.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Throughout this earnings season, there is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations, investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really, really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It doesn't feel like we've had a weekend for about a month, but let's attempt to anyway. Let's get you to the weekend. From New York City this morning, good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, heading towards another week of losses on the S&P 500, a third week of losses. On the Russell, we're looking at a third week of gains. Check out the future right now. The futures board on the S&P 500. We're up by 0.75% on the S&P. On the NASDAQ 100, we're positive by 1%. The outperformance once again on the Russell 2000, the small caps up by 1.5%. The stat of the month comes from Jim Reed at Deutsche Bank. The MAX 7 down nearly 13% since the record high back on July 10th, with the Russell and the small caps outperforming, Lisa, by a remarkable 24 percentage points over the period.
That statistic highlights the ultimate question underpinning what we've seen over the past 3 weeks, which is this a gloomy sell-off on the heels of some sort of growth scare, or is this a really healthy kind of growing pains related to a sort of positive transition to some of the more leveraged stocks to the economy? That ultimately is the angst underpinning what we've seen.
Yesterday was a super messy session, and we'll be talking about that mess throughout this morning. We need to talk about the economic data. PCE a little bit later on this morning. Yesterday, jobless claims. You just got the sense from a lot of people that claims were the difference between having time and running out of time. And there was a belief based on claims coming in a little bit better, GDP coming in firmer than expected, that we have just a little bit more time. Companies are saying something very different though, Lisa. Big airlines are warning about airfares. Automakers like Stellantis are struggling with sales. You go through the top and bottom end of the consumer. The world's largest food company, Nestle, cutting its outlook. Even the luxury players like LVMH and Kering are coming out and saying, you know what, I think we've got a bit of a problem.
The problem for market participants is understanding if this is a problem with margins, if this is a problem with consumers that still have money but are being more discretionary with where they spend it, and actually just an incapacity to spend. It's two different things, because you also had Hermes, evidently Birkin bags are just fine. So on the flip side, it's sort of selective spots that are doing just fine while everything else kind of struggles. You look at going forward, and it seems like we're moving to a point where September is a lock-in. July is out of the picture, next week is out of the picture, but ultimately there is a distinction between preventative rate cuts and reactive cuts. And the market is coalescing around the idea of preventative rate cuts in September, which could be less of a negative than reactive cuts to true deep weakness.
Don't you think the Birkin bags are like their own universe?
Yeah.
Got low end, high end, and then you've got Birkin bags.
Maybe it's the people who buy them are in their own universe. Maybe that's part of the distinction.
It's like 50 people on an expensive island somewhere who can afford them. Equity futures on the S&P look a little something like this. We're firmer by 0.75% on the S&P 500. This is your bounce back from a really volatile session yesterday. In the bond market, the 10-year 423.28, and in foreign exchange, the euro at just about 108.50 and positive by almost 1/10%. Coming up on this program this hour, we'll catch up with Ben Laidler of Bradesco on the Great Rotation, Tobin Marcus of Wolf Research as Trump and Harris debate the next debate, and former World Bank President David Malpass ahead of Treasury refunding next week. We begin with our top story, the Great Rotation gathering some momentum. The Nasdaq starting down a third week of losses, with the Russell looking to make it 3 weeks of gains. Ben Laidler of Bradesco writing this is the longer-awaited bullish rotation in markets, not the start of a broad correction. This broadening is key to the sustainability of the bull market. Ben joins us now for more. Ben, let's get there. First of all, as we stare down a third week of losses on the Nasdaq. Ben, tell me what you look at to distinguish between something bad and something good when you see price action like this.
So the tectonic plates of this bull market are absolutely shifting. That's unleashing some tremors, but this is a rotation, not a sell-off. The equal weight S&P is up over the last few weeks, even when, as you mentioned, big tech is in this fairly significant correction. And I think this is emblematic of what's coming. Markets are looking at the assets which are most sensitive to the economic soft landing and interest rate cuts. And small caps is just the canary in the coal mine here. That's why it's reacting the most violently. But it's also, I think, a reminder of how a little bit of money can go a very long way in all these assets, whether they're in the rest of the world or all these other sectors, which we basically forgot about over the last few years as this sort of one-legged big tech bull market sucked up all the attention.
Ben, let's dissect it. Let's dissect this mess over the last couple of days. You identify 3 different things. What's driving it? What's amplifying it? What's globalizing it? Can you just go through that point by point?
So, big tech's had this massive rally, valuations, obviously high, everybody's built up on AI, et cetera, et cetera. Any sort of disappointment, and maybe we got that from Google, just amplifies the angst which is already out there, and people that were looking to pull those triggers, pulled those triggers. I don't think that means that tech's a bad story, though. Tech was doing very well before AI. Tech doesn't need AI. It's just maybe things got, a little bit frothy. But this is 30% of the S&P 500. Concentration is very big, and that unleashes some sort of volatility. But at the same time, we have data which we saw yesterday, which I think validates the soft landing. We have a Fed which is getting ready to cut in September. This is pouring gasoline, I think, on looking at those assets which are most sensitive to that scenario. And that's not big tech, that's everybody else. And then thirdly, the US has just got so sort of supersized that any stumble, I think, reverberates around all assets. And that's the cost, I think, that we've taken in many parts of the world. I'm sitting here in the UK over the last couple of weeks. But I think that will fade. And I think actually many of these assets, whether they're emerging markets or Europe, are in this sort of same bucket as sort of small caps, which will do very well in this new environment, and where a little bit of money will go a very long way.
I love that a lot of people come on the show and they have vastly different appearances in terms of their outlooks, and then you start talking about their time frames, and it turns out that they all have the same view. It's just sort of depending on where your time frame is. What is your time frame for this great rotation and this sort of wonderful outcome, given the fact that over the short term, there are a whole host of different analysts, including Julian and Manuel, who see this continuing on a technical basis, who see this continuing potentially if we don't get massive beats from big tech next week?
Yeah, so ultimately, I think, the fundamentals matter. And I think the fundamentals sort of support this rotation. Tech is not growing earnings, or big tech, 70% anymore. It's still great. It's going to be 40 to 50, but absolutely it's a consecutive slowdown. And at the same time, everybody else is no longer in an earnings recession. Those earnings are consecutively recovering, and I think we have visibility on getting back to double digit by the end of the year. So I think this rotation is very fundamental. I think it will happen reasonably slowly, or at least I hope it happens reasonably slowly, because what we're seeing right now, I think, is just the big tech has got so supersized that when it stumbles, it spews volatility everywhere. We have the VIX now, back at long-term average levels. So, I'm a little bit scared of the very short term, but I think there's this rebalancing of the economy and of the stock market will hopefully be a moderate that plays out over time. And remember, we've been waiting for this for a very long time.
You said fundamentals matter, and you're talking about how smaller companies should really benefit in this kind of environment and have been sort of thrown out with the bathwater. How do you understand Ford? How do you understand Stellantis? How do you understand American Airlines and Southwest and all of these different companies, consumer-facing companies that are coming out and saying, actually, things are getting worse than we thought that they'd be, and we cannot pass on our price increases?
Yeah, absolutely. And this is why I think, there are going to be plenty of idiosyncrasies out there, right? There are 500 stocks in the S&P 500, but I think overall, as we saw yesterday, the consumer continues to be in pretty good shape, incrementally slowing. Demand. This is not a demand story. This is a story where demand is okay, where profit margins are getting a little bit of relief because inflation's come down. We're seeing overall profit margins in the S&P 500, rising. And I would argue that outside of the Mag 7, earnings expectations are quite low. And I think this is why, and we're going to find out next week, 40% of the S&P 500 reports, 4 of the Mag 7 report. But I think this is going to be the best earnings season in 2.5 years. Let's not lose sight of that. Earnings are going to be healthily double-digit, I think.
So, Ben, let's take out tech and let's just look at the consumer names, particularly the story that Lisa just mentioned. Demand's okay at the right price. And I think that's what we hear from all of the airlines. I think that's what we see from the automakers as well. They don't have the pricing power anymore. And when that starts to happen, we know what starts to happen with margins and what happens elsewhere. So, Ben, where do you get that confidence around that consumption story when what we're hearing from the companies is that they don't have pricing power anymore?
Yeah, I think this is going to gradually play out. Am I a little bit concerned of the sort of face-ripping rally we've had in small cap and how much we've priced in the last 2 weeks? Yeah, I am a bit, because I do think, this will take a little bit of time, right? The economy will probably keep incrementally slowing, but we need the interest rate cuts to sort of come through. The consumer, the economy will gradually sort of firm up. I think in the US, what I would also say is there's a big international component to this. The global cycle, I think, is quite different from the US cycle. Europe, EM has either bottomed or started to recover, and I think that earnings cycle is A, maybe a little bit further ahead, and B, it's a lot more cyclical. So in Europe, for example, this is going to be the end, this quarter will be the end of the earnings recession in Europe. And I think by the end of the year, we could be seeing 20 or 30% earnings growth in Europe, just given the cyclicality of earnings. And I think the same goes for parts of EM and potentially parts of small cap.
When we're talking about timeframes, it's actually quite important because a lot of people have come on this show and said, for the remainder of this year, there is some visibility. There's a sense of what different economic policies could be. There's a sense of some of the dynamics heading into November. After that, it gets a lot harder. What gives you conviction that regardless of who wins the U.S. election and some of the policies that result from that, you still could have the environment that you're seeing that could be supportive of smaller companies, even though there's some pretty differing kinds of policy proposals out there?
Yeah, to be clear, I'm not sure small cap will be the first place I would go. As I say, that is the canary in the coal mine. That's giving us a very clear signal of what people are looking at. But, I'm not that bullish to think that, the US economy is just going to turn on a dime here and that's going to take small cap with it. So, I would be looking at financials, I'd be looking at industrials, I'd be looking at Europe, I'd be looking at EM, maybe before I go to small cap. But again, I think, the US economy is in a good place. We are about to get insurance interest rate cuts, from the Fed, which I think will go a long way to giving us maybe incremental visibility on that. And maybe controversially, I think the election is maybe a volatility event and maybe less of a fundamental event. In fiscal policy, for example, I don't see huge differences between the candidates. I think the base case is we end up with a gridlock Congress. I think the risk is we overdo the politics a little bit.
Ben Laidler of Bradesco, offensively bullish. It's got to catch up, sir. Ben, thank you. Appreciate it. Look, one person's rotation is another person's growth scare. That's the last week or so. Bank of America, Michael Hartnett putting it like this. Credit spreads signal the correction's healthy. Then you look at the yield curve and commodities, and they say it's sinister. Got to pick one.
It's very difficult, and the different economies have been moving in different kind of pacing, and that's part of the problem. I like how language matters. For bears, it's profit margins are getting squeezed. For bulls, it's profit margins are getting some relief. It just sort of highlights, you know, how you look at things.
A very different way of framing things. Some people enjoying their weekends, other people not so much. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. Uber, Lyft, and DoorDash have won a California lawsuit. The state's top court unanimously ruled that the companies can continue to classify California drivers as independent contractors. The ruling clears what investors had regarded as a major regulatory hurdle. It's also expected to save companies millions of dollars that they otherwise would have had to pay drivers. App-based gig companies have long argued that their drivers aren't considered employees entitled to minimum wage and overtime protections. Despite the unanimous ruling, further legal and legislative fights are expected ahead. And as the Olympics kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say that people were seen fleeing the sites in vans. Eurostar, for its part, says that its services to London and Brussels have been impacted, with several trains delayed or canceled. The National Rail Company says it will have to repair its network cable by cable. And that's your Bloomberg Brief. John.
Not a great start. That is super sad. Danny, thank you. Danny will be back with us in about 30 minutes' time. Up next on the program, debating the next debate.
I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. I think the voters deserve to see the split screen that exists in this race on a debate stage.
We'll discuss that split screen up next, live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, the Fed decides.
You said summers were quiet. I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Already looking ahead to quite a big week. Next week, this time Friday, we'll be talking about payrolls. 2 days before that, we've got a Federal Reserve decision, and somewhere in between, some of the biggest companies on the planet reporting earnings. Going into all of that, equity futures look like this. We're positive by 0.75% on the S&P 500. A little bit of stability and some calm for once in the bond market. We do nothing. The 10-year, 423.67. Other surveillance this morning debating the next debate.
So many of you have been asking me about the debate, and I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. He agreed to that previously. Now it appears he's backpedaling, but I'm ready. And I think the voters deserve to see the split screen that exists in this race on a debate stage. And so I'm ready. Let's go.
Here's the latest this morning. Donald Trump's campaign refusing to commit to a debate with Vice President Kamala Harris until she officially becomes the Democratic nominee. A campaign spokesperson saying it would be, quote, inappropriate to schedule things because Democrats very well could still change their minds. Harris responding on social media saying, quote, what happened to any time, any place? Tobin Marcus of Wolf Research joins us now for more. Tobin, a bit of news this morning already. The elusive endorsement gets delivered by the Obamas to Kamala Harris. There's a bit of a honeymoon period over the last couple of days, Tobin. I'm just wondering from your perspective how much longer that honeymoon period lasts.
Well, I think that depends in large part on how Vice President Harris continues to perform on the campaign trail. Part of the reason why Democrats have been so energized and unified is just the relief at being out from under this Biden catastrophe that they've been living through for the course of the past month. But another part of it is that she's looked pretty good on the trail. You know, the early paid media's look good. A couple good ads up so far, and a string of, solid performances from her. So, she keeps delivering good performances. I think Democrats are very ready to remain enthusiastic. I think there's a sort of palpable eagerness to have something to root for. But, obviously her 2020 campaign did not go flawlessly, to say the least. It's totally possible that we see things start to go a little bit, less uniformly positively. And if so, then I think we'll start to see cracks on the Democratic side.
Tobin, I thought that the New York Times Siena poll that just came out yesterday was fascinating, not because it showed that there was more of a tie between Kamala Harris and Donald Trump than we've seen for months with with President Biden, but this part, it said that nearly 90% of voters said they approved of Mr. Biden's decision to exit the race. When have you ever, Tobin, seen 90% of voters agree on something so pivotal as the sitting president stepping down from a race?
Yeah, that's about as high a number as you can get in polls. As someone who has run a lot of polls in my life, you can. It's really hard to come up with something that gets a higher number than 90. So look, I think it just goes to show again how much palpable relief there is at being out from under this. There were differences of opinion, obviously, on the Democratic side about kind of how to handle this, how much pressure to put on Biden. There were certainly some people, including, for example, the Congressional Black Caucus, who were standing with Biden through much of that pressure campaign to try and get him out. But now that he has left, I think there's very, very little second guessing of that. And, again, there are some people who were hoping to have another candidate come out somehow, find some way to run a mini primary, figure out if you can get one of these promising Democratic governors at the top of the ticket instead of in the runner-up slot where they're being considered right now. But that was never really an option. And with all those people immediately bowing out, I think people are now backing the horse that is available to cheer for.
Tobin, there were a lot of people who are scratching their heads at the J.D. Vance pick by former President Trump as the vice presidential pick, given the fact that he hews very closely to Trump when it comes to some of his policies. Within the Democratic Party, how much momentum is there for picking a vice presidential candidate that really is more centrist, even than perhaps Kamala Harris?
Yeah, I think that's what's going to happen. There's questions about which one of the various different vice presidential hopefuls she will end up going with. But, I think common sense and the reporting about who is being vetted all point in the same direction, which is that she's looking for somebody who has some, moderate record and some outside the beltway sort of vibes to them in terms of people to round out the ticket. Again, could be governors, could be Senator Kelly in Arizona, who I think reads a little bit less Washington-y than a senator usually would by virtue of his experience as an astronaut rather than a career politician. But one way or another, I think she is looking in the obvious place for the kind of person she'd want to fill out the ticket.
Tobin, it's been interesting to see the media and Democrats in the last couple of days or so almost try to remodel perceptions of Kamala Harris's role in this administration to separate her from the border by pointing out repeatedly, we might have called her the border czar, but she was never the border czar. This was about root causes. Tobin, I just wonder whether you can pick and choose, whether as the vice president you can say, I was involved in this, I had nothing to do with that. Can you really do that? How much distance will there be between her and the Biden legacy?
So, obviously she's going to face attacks for everything that happened under the Biden administration. Both things in which she had some level of direct role, like, again, this sort of disputed portfolio about what exactly was her responsibility in terms of addressing the root causes of immigration. But even more broadly, things that happened that she had nothing to do with, she will continue to face criticism for. I have no reason to think that the Trump administration, for example, is going to stop criticizing the withdrawal from Afghanistan and kind of pinning that on her as a member of the Biden-Harris administration, even though nobody believes that she was the decision maker on that. That being said, it does seem to be the case in some of the early polling from Democratic pollsters that there is less baggage with her than there was with Biden. On inflation, for example, which obviously had been one of the persistent vulnerabilities for President Biden in addition to his age, looks to be the case that there's a little bit less association of the retrospective bitterness in the run-up in price levels, distinct from the current run rate of immigration for Harris rather than Biden. And again, a lot of it comes down to her. How effectively can she pivot away from some of these attacks, both on the Biden record and on her past positions, where obviously Republicans are already, kind of criticizing her for all the position taking that she did in 2019 and 2020 around banning fracking, around decriminalizing border crossings. These various different things that she kind of signed on to during that primary when a lot of Democrats were racing to see who could get farthest left. But again, flip-flopping is a thing that happens in politics. If she can give a compelling account of where she stands now and what she wants to do going forward, I think it does, mitigate some of the vulnerability from things she said in the past.
They are the ultimate shapeshifters. I expect no different from either side. Tobin, thank you, sir. Tobin Marcus there of Wolf Research. I keep going back to what Libby Cantrell said just yesterday. Ignore the polls. Wait until September. Got to wait for the DNC, see who the VP pick is. Let all this bed in. Just wait a while, and then we'll get a better gauge of where things stand in this country.
That's the reason why I thought that just the approval of where we are right now was sort of shocking. The polls maybe not so much because those are going to change quite a bit, but the fact that everyone did not want the race that we were having, and they're so happy and relieved. You wonder how low the bar was for anyone to come in who is under the age of, say, 70 to really re-galvanize this race.
The double haters was a big, big deal in all the polls over the last year or so. Coming up next on this program, the yen rally at risk of breaking as investors await rate decisions from the Fed and the BOJ. That's next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Live from New York, welcome to the program. Here's the state of play for you. Positive by 0.75% on the S&P 500, bouncing back by almost 1% on the Nasdaq 100, and once again, massive outperformance on the Russell 2000. Small caps up by 1.65%. As of yesterday at the close, still poised for a third week of losses on the S&P and poised for a third week of gains on the small caps. In the bond market, your yield curve looks like this: the 2-year, 10-year, 30-year doing nothing. We can take a break for once. The 2-year down to about 442.45. There was just a feeling that the data yesterday gave us a real break that we could go into the Federal Reserve on Wednesday next week without this urgency that they need to cut interest rates because the labor market is breaking. I just wonder whether Friday's payrolls number endorses that view.
At a certain point, it seems like people are rallying around the idea that these can be insurance cuts or preventative cuts of something that is more pernicious. And yesterday's prints really seemed to highlight that seemed to be the case. Question is just how much the Fed commits itself. And to Bill Dudley's point, what we're not seeing, because there have been a lot of downward revisions in the labor market data, and that, I think, is one thing a lot of people are pointing to.
I think this comes down to two things, Lisa. I think it's one, what is your assessment of the labor market? And two, what do you infer from that as to how much time you think you have to remain on hold at the Federal Reserve? And when we spoke to Bill Dudley yesterday, his view on one was that this labor market is more fragile than the Fed thinks, and two, they have less time than maybe they think they do. And this is what's interesting about next Friday for me. How does this market respond if we get a bad payrolls number? How does this market respond if we get unemployment going through the so-called SARM rule? Is the Federal Reserve comfortable with all of that? They might just say it's a one-off. Based on some of the commentary we've had over the last couple of days, I can imagine people piling on and saying, this is it. They've got to make a move. It's growth scare. The labor market's breaking. We're heading to recession. The SARM rule's triggered. Then you've got an even messier market. And we're this close to something like that happening.
You frame this as, how will the Fed respond to this? There's also this question of, how does the market respond to this? And we've kind of gotten a sneak peek at just the surface of how that response, how deep that response could potentially be. What we're looking at in markets is the hope and the prayer that the Fed cuts rates proactively. If they cut reactively, we've gotten a sneak peek of just how much we could see that sell-off. And Michael Hartnett of Bank of America saying, actually, even financials are set to lead downward if we do get a true growth scare and do see some of these revisions continuing, particularly on the negative side in the labor market.
Michael's point, he says we're one bad payrolls report away from all of that. Let's see if that payrolls report comes on Friday. The trend over the last 2 years has been a surprise to the upside. So let's see. Let's turn to foreign exchange. I want to talk about dollar yen. The range on dollar yen in yesterday's session, okay? At the low of the session, 151.94. At the high of the session, 154.32, and at the close, just short of 154. Right now, we're back to 154.30. We had saw massive swings on stocks like NVIDIA, but we also saw big swings cross-asset in currency pairs like dollar yen in yesterday's session. I think as things stand still, we're still heading towards a fourth weekly decline on that currency pair. Haven't seen that all year. Going into quite a big week also for the Japanese next week.
Yeah, for the Bank of Japan to come out and decide whether or not they're going to hike rates. In a lot of the research notes that I've been reading over the past couple of days, the ultimate question is, how vulnerable is this market to an inactive Bank of Japan meeting? If they do not raise rates next week, how much does this yen weaken right back to where it was before this rally began? It feels technical in nature, unclear what's driving it. The Bank of Japan could quash that if they want to by simply doing nothing.
Dollar yen 154.30. Under surveillance this morning, our top stories. Let's start with this one. Vice President Kamala Harris pushing Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire deal with Hamas, highlighting concerns over the civilian death toll in Gaza. Netanyahu also met with President Biden and will be visiting Donald Trump at Mar-a-Lago later on today. So picture this, you're a foreign leader and you've now got to meet with three. Got to meet with the sitting president, separately from the vice president, and also you've got to meet with the former president, who might be the next president as well. What on earth does policy look like after January?
Well, this is part of the reason why Peter Scheer is very concerned about some sort of geopolitical issue springing up now, because it feels a little bit, not that there's a vacuum of leadership, but that it's unclear who has the strongest grip over policy going forward, and I'm talking about beyond January of next year. It's interesting to see how Kamala Harris was trying to create daylight between her policy and Biden's policy, coming out with some harsher words for Netanyahu. And then, of course, you have Donald Trump, who is a huge supporter of Bibi Netanyahu. And this sort of acceleration of the divergence in U.S. politics by Netanyahu is something potentially some people have speculated he could exploit.
He's in a hot war. You've got Ukraine in a hot war. And they could have a very different relationship with the United States of America come January, depend on who wins in November. That's quite a turn of events. The lack of continuity in foreign policy in America, I think, is what Peter Scheer is getting at over at Academy.
And it starts to sort of raise the question of what could happen. You start talking about Ukraine, and Volodymyr Zelensky really said, look, I know you don't want to talk about things publicly, but just let us know. If you're going to be playing with our future, I just want to know what the policies are from the prospective nominees, because a lot could change, and we want to be prepared.
That's the latest in Washington. Let's get to the latest in China. Apple losing ground. How many times have we seen reports like this? Market tracker IDC saying iPhone shipments dropped around 3% in the last quarter, pushing Apple out of the top 5, as local rivals such as Huawei have been surging ahead. Even deep discounts, and I think this is the important point here, failing to help boost sales of Apple at a time when the sell side leads are getting bulled up on this idea that when the new iPhone drops in September, you're going to get this massive upgrade cycle off the back of it.
So here's what I'm looking for. How many international companies are going to start to X out China and propose growth models that have nothing to do with that nation? Because essentially there have been a number of reports that a number of the executives who went to China from the United States, big heads of multinational companies, don't know how welcome they are. And the rhetoric is not convincing because policy has not been. With Apple, sure, you could say that the price is probably part of the issue. You could say also that, hey, the phones have been banned by a lot of governmental agencies. There's a big push into national companies which have exceeded, all of them have exceeded Apple for the first time. It just creates a very difficult environment to really have any predictability. We're talking about U.S. policy uncertainty. Sure. How about China policy uncertainty for some of these companies?
Look, that environment is always going to be cultivated by the central government, by the Chinese Communist Party, but also this turn of consumption, how consumers have gravitated towards national players. You mentioned Peter Scheer. That's also something Peter Scheer's been on top of. How welcome are they, not just by the government, but also by the consumers on the mainland?
Which, again, goes to this point of how much are companies still expanding in China? You know, whenever we ask people about China, executives of companies, they always really hedge, almost invariably. Qualcomm CEO is a little bit different. He said, we like China, it's important for our business. But most executives say, you know, we're cognizant of some of the risks. It's an important market. We are aware. We want to make sure that we're, you know, being within everybody's guidelines. What they're doing is totally different. They're moving production to India. They're moving away. They're diversifying their supply chains. They're very aware of the potential risks.
It's not what they say. It's the physical reaction that gets me. You know, the jacket will be done up, and then they'll undo the button because it's getting a bit hot. And then they don't know what to do with their hands anymore. So they're sort of like this, China, yeah, no. It's the physical reaction. You just saw them, they react physically to it. They know it's a topic they've been briefed on by public relations just not to touch. Don't go there. Don't go there.
Nothing good can come of it on either side of the equation.
We keep asking. Apple's positive in the pre-market, we're up by about 0.9%. It's a difficult one for them, I know. I want to turn to foreign exchange. Investors looking ahead to a double dose of central bank rate decisions in the next week. The Fed and BOJ both drop on Wednesday. The yen rally facing a moment of truth as the currency holds onto an advance of about 5% against the dollar since just before it began surging on July 11th. Jeremy Stretch of CIBC writing this: should the bank desist from tightening next week, as we assume, we would be mindful of dollar yen retracing half of the recent correction. Hence, we are mindful of a correction back towards 156.90. Jeremy joins us now for more. Jeremy, we've seen massive swings in dollar yen over the last couple of days. What do you think has been going on? Is this all just about fundamentals and looking ahead to the prospect of a rate hike next week, or is it something more than that?
Well, I think there are a couple of things definitely in play in the context of this move. Clearly, we've seen excess yen short positions. Some of those have now been partly compromised. But I think also at the same time, we've seen increasing speculation